Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Thursday morning, we are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Surabhi and Nigel. Guys, hi, good morning.
Hi, good morning. Folks, I guess markets feeling slightly better because that climb down that kind of started 24 hours back with statements, that seems to be continuing out in the US.
I mean, the tone tenor all suggests de-escalation from the US's side.
Indeed.
Everything else we'll have to see.
Indeed, but don't count out a tweet coming in from Trump anytime soon. So let's see how that goes. But it's the expiry day. It's been a good series. So hopefully the Bulls can push home the advantage. I think we're up 3.5% for the series itself. Expiry
days are tricky, Nigel, right?
Yeah.
Only, I guess, some say the only one guy matters on expiry day. The guy's not in India. Anyway, let's just quickly run you through, the big top-down stuff that you need to know as we begin, and lots of trade headlines, right? I mean, I was just joking with somebody that I'm getting up earlier and earlier, but I'm getting to office later and later.
Because there's way too many headlines and tweets and posts to go over.
Yeah, I mean, just the volume of, and it matters, right? Because what was said post-market hours, what was said during the session, some stuff has come through, it's been it's been clarified henceforth and so on and so forth. So let's take it from the top, right? US equities, recovery continued, S&P about 1.25% higher, NASDAQ about 2.5% up. So those are changes. And a large part of this is to do with headlines which came after US close the previous day, which is yesterday morning, our time, those headlines, right? I mean, there are two things. One is that Trump said he's not planning on firing Powell. And the second, of course, was the thing on China, that, we will perhaps, we will be looking forward to some kind of a deal with China. So conciliatory on both fronts, backing off on both fronts. So it came after US close. US futures were higher. So there was that lift in any case, which came through. Now, during the US session last night, you basically had the Wall Street Journal, which reported that Trump administration may slash steep tariffs on China to between 50 and 65%. Now, remember, Rahul Chadha, who's a veteran investor, we spoke with him same time yesterday, he kind of made the same point. He said, well, he wouldn't be surprised if the next 10 days, tariffs are dropped to from 145% to 40%, 50%. The Wall Street Journal story sort of made a similar pitch. But then after that, you had the Treasury Secretary, Scott Bessent, who clarified that there is no unilateral offer to cut China tariffs. It's not as if the US is going to say, well, it's not 145, it's 40, now let's start talking. It's not unilateral. We'll need to see something from the Chinese, and then we will decide to do what we can do. By the way, Scott Bessent, the Treasury Secretary, gave a speech, and it was widely watched, and we'll play some of it a little later here on the program. He said that looking at multiple factors like non-tariff barriers, government subsidies and tariffs with respect to China, and a full rebalancing of US-China trade might take 2 to 3 years. Now, he's saying rebalancing, not a deal. The deficit, basically, to rebalance it, of course, it will take that long, maybe even longer. But that, and of course, there was that one soundbite, I think, where he said, well, America first does not mean America alone. I think that also at the margin really helped sentiment. Now, US PMI numbers were solid. Services, there was a bit of a slide compared to the previous month, but I would say solid. Manufacturing PMI actually expanded. A surprise relative to consensus calls for a contraction. Now, I'll just come to, based off all this news flow, the price changes. The VIX was down about 6-7%. The 10-year lost about 2 basis points. So bond prices went up. Dollar index, has been hovering around the 100-odd levels. So 99.80 by the time US closed yesterday. Oil prices, which had gotten to about 68, we're back at about 66. So not very much by way of change. Now, after New York close, the FT reported, and I think there's some confirmation to it now, Trump is exempting car parts, auto parts, from tariffs on China imports. Various people and important people like Elon Musk have complained about this. And I think there is some amount of leeway which is happening. So not surprising. He's done similar things for Canada, Mexico as well. And of course, after New York closed, last night's close, Trump also went on to say that we're not doing any business with China right now because the tariffs are so high. I'm hoping to make a deal. If not, we will set the price. That's essentially what he said. And he went on to add that those businesses and countries which don't reach out to the US, we will set the tariff in the next 2 to 3 weeks. So that was another one which came through. I'll just sort of leave you with the levels. Not very much change. I mean, many have been surprised. At least from yesterday, been a little surprised with the strength that we've been seeing. The continued non-stop strength. 7 days higher on the Nifty now. The levels, of course, upside level, 24,546 is where we are at. Support stands at the 40 hourly, which continues to be dragged higher, 23,865. The upside level is the 61.8% retracement of the full fall, as we've been pointing out. Bank Nifty saw a negative daily close yesterday. There is some loss of momentum, but there is no real change of trend or anything of that sort. Support, again, 40 hourly, which is 54,390. Resistance at yesterday's high, which is 56,098. And then 56,631. Gift Nifty will give you a first sense of how we're likely to start. We're down about 50 points. Surabhi.
Absolutely. Asian markets largely positive, tracking these developments off Wall Street. The fact that there is a quote-unquote de-escalation and he's not looking to fire Powell, and maybe in some shape, way or form, there will be a deal with China. It won't be as bad as 145%. And that's leading to some kind of, an uptick in markets like Japan. Actually, the Korean, the Hong Kong and the Shanghai markets, they're the ones that are not really feeling the love, so to speak, right now. Hang Seng is down, Shanghai is absolutely flat. But other regional markets, Japan, for instance, is up about 1%. Singapore is also tracking minor gains at this point in time. The story out of South Korea is not too great in terms of macros. Their first quarter numbers are in GDP numbers, and there's contraction there versus expectations of a 0.1% increase. The economy is contracted 0.1%. This is before the effect of tariffs kicks in. This is the first contraction that South Korea has showcased since, COVID 2020, so in the first in 4 years, so to speak. By the way, just pull up the price of gold, because I'm just seeing in Asian trade, this market, gold has started its winning form once again. Gold is up almost 2% in Asian trade this morning, levels of around 3360, so to speak. So keep an eye out in, because yesterday gold took a breather. It hit that high level of 3,500 in US trading. Then it cooled off. But that's what I'm talking about. 2% up again on gold. So that big move continues as well. Now let's talk about, of course, earnings. In South Korea, by the way, there was this, semiconductor major SK Hynix. Big numbers there. 158% kind of jump in profits. So the semiconductor story is still strong. But speaking of earnings, that's exactly what we will track. That's the primary fulcrum of our market action today. Tata Consumers numbers better than expected. Revenues up 17%. The margin has fallen, but it hasn't fallen as badly as the market feared. So that's the good news. LTI Mindtree is in line. There's no major negative surprise in LTI Mindtree. The margin has held, so the market should take heart from that. Today is a very, very big earnings day. It's almost a breathless list. Axis Bank, lots of consumer names. HUL, Nestle coming through. Lots and lots of IT names. There's Tech Mahindra, Cyient, Persistent, Memphis, L&T Tech. Beyond IT, there are names like SBI Life, SBI Card, ACC. So, strap up. It's going to be a hectic session. On the fund flow picture, absolutely no problem whatsoever. Again, we got a big inflow yesterday. 3,300 crores of buying coming in from the FPIs. Domestic institutions on the sell side. They sold off cash equities worth about 1,200 crores. Now, but beyond all of the market headlines and tariffs, I am going to watch out for the geopolitical situation here in the country very, very carefully. Hectic developments since yesterday. Let's not look away from the kind of diplomatic strike India has done against Pakistan just yesterday itself with the abeyance of the Indus Water Treaty. The Atari post has been closed with immediate effect. All Pakistani nationals have been given 48 hours to leave the country. So it's very, very significant steps in terms of the geopolitical climate here. There is an all-party meeting, and we have to wait and watch for the next steps as well. So that obviously, in a larger context, will have a market bearing. Let's wait and watch on that perspective. Nigel, over to you.
Well, it's going to be expiry day that plays out yet again. It's going to be the second series that we're going to be going home with some gains. So on the Nifty, we're up close to 3.5%. The Nifty Bank has done even better with a gain of close to around 7% or thereabouts. Rollovers more or less in line with what we have seen on an average, both on the Nifty as well as on the Nifty Bank. Well, I think, the Nifty Bank, the one that's been an outperformer, will be the one that holds the key for the Nifty to trend higher from here on. And I say that because, in fact, it's finding some kind of resistance at higher levels. Last couple of trading sessions, it's gone to that 56,000 odd mark. And from there, it's seen a bit of a rejection. So that's why this level becomes very, very important for the Nifty as well, given that the Nifty Bank constitutes nearly 30% of its weightage. Crossing this 56,000 odd mark, that's the next key for the bulls to trend higher from here on. So I'll keep an eye out on that. Moving to what the FIs did, as you'll have been mentioning, they've been buying in the cash market. And yesterday, there was a bit of a short covering bounce that did play out as well, because they covered shorts on index futures. On stock futures as well, 52,000 contracts were covered out. That could be a bit of a reverse arbitrage that's taking place. Earlier, they were selling in cash and they were buying stock futures. Now that seems to be reversing a little bit. So that is, the reverse arbitrage that's taking place. So some kind of short covering is what we saw yesterday. But just take a look at that short covering bounce that we have seen. We started the series with the FIs being net short, not so large though. And initially they got it right because their short positions went up drastically by close to around 4 times. And we had the Nifty that came down by close to around 1,000 points. But after that, they have got stumped on the wrong side because you see the shorts, they have gradually been getting covered out. Now they're at around 70,000 short contracts, while you have the Nifty that's trend up a big rally, close to around 2,000 points is what we're seeing as that short covering bounce has taken place. So the FI shorts, they have got stumped on the wrong side. Given that today is the weekly expiry, the last 60 minutes, you'll get some volatility. And looking at the options data, we'll get a few hints out there. So in yesterday's trade as well, 24,350 call, 24,300 call, both of them were fairly active. So just punching in those levels and going by the premium out there, the important resistance mark for the day is around the 24,420. That's the important mark you'd like to see. And in fact, on the Nifty, you have the 200 DMA added on the 24,000 odd mark, which becomes an important support level. The one that I'm going to be tracking today, a couple of stocks because of the commentary that we had from President Trump with regard to some kind of exemptions on auto components. Well, I'll keep an eye out on both these two, Sambandana Motherson as well as Sona BLW, because both of them had got hit earlier. Let's see whether or not we're bracing for a bit of a relief rally on both these two.
Okay, all right, got that. So those are the key cues to watch as we go forward. Let's start off with then the equity call of the morning. And this one's coming in from Anubhav Agarwal of UBS, who says that they are positive on the Indian market for 4 reasons. They expect a consumption-led recovery in FY26 and FY27 after a weak consumption and capex cycle in FY25. He says lower oil prices and GDP growth and help in lower inflation. They also think that India looks better placed than its Asian peers to weather US tariff impact and a global growth slowdown, and valuations are reasonable with the market's 1-year forward PE multiple at past 7 to 8 year average. He says the top 6 buys in the country include HUL, ICICI Bank, Interglobe, Sun Pharma, Trent and TVS Motors. Their sell stocks are Asian Paints, Bajaj Finance, Cummins and Jubilant FoodWorks.
Absolutely, and we'll get you more as we go along, more opinion that is. Now let's listen to Treasury Secretary Scott Bessent, that speech which was widely followed, widely tracked. Some important points here. Listen in.
There is an opportunity for a big deal here, that the U.S. is looking to rebalance to more manufacturing. The identity of that would be less consumption. If China is serious on less dependence on export-led manufacturing growth and a rebalancing toward a domestic economy. And if they want to rebalance, let's do it together. This is an incredible opportunity. I wish to be clear, America first does not mean America alone. To the contrary, it is a call for deeper collaboration and mutual respect among trade partners. Far from stepping back, America First seeks to expand U.S. leadership in international institutions like the IMF and the World Bank. By embracing a stronger leadership role, America First seeks to restore fairness to the international economic system.
Okay, and I urge you go and listen to that full speech made by Scott Bessent. And Scott Bessent, of course, is very much a market, has been a market operator all his life and knows what's at stake. Drew Pettit is with us, Director, U.S. Equity Strategy and ETF Analysis and Strategy Research at Citi. Drew, good to have you back on the program. Thank you very much. And just a quick word, Drew, on just the overall thrust and which way it is going. It just would seem like to an outside observer that the US and the Trump and the trade team, because there are so many people who talk out of the US and on these issues, people in power, that they are kind of becoming a little more conciliatory. They're open to a deal, etc. We've not heard China is silent. I mean, I guess biding its time. What is your sense? That's the right way to look at this?
Yeah, the tone has definitely changed in the past few weeks. Look, it started with the 90-day pause, and we saw the market reaction there. But then on the other side of this, too, you got to think about what's happened to the treasury markets and even the dollar here. So you were starting to see weakness in the dollar. You were starting to see weakness in treasuries, just higher yields. Those things do matter to the administration as well. So the conciliatory tone is kind of helping all of those assets, and it's helping U.S. equities. So, yeah, look, the tone has changed, but we do have to remember, because of how aggressive the Liberation Day tariff announcements were, we're probably not going back to, where we were before. We're still expecting a higher base case of tariffs. And the other agenda for tariffs for the United States is some revenue generation as well. So, look, this all kind of feeds into, it's less bad than feared on Liberation Day, but it's still probably going to settle out higher than where, at least where we expected it at the beginning of the year.
Drew, and that's the point, right? If you start at 145, there are so many levels lower down that you can declare victory. So if they declare victory, say, at 60%, which is the level that has been spoken about before the election, during campaigning, etc., right? The 60% tariffs on China. So if you go from 145 to 60, that is equal. It doesn't matter if it's 100 or 145. There's no trade there. But 60 is equally, not equally maybe, but it's still bad, isn't it?
Yeah, it's still dense. It's still dense U.S. earnings and companies that source out of China. Look, when we thought about this impact across sectors, the more aggressive China tariffs have a greater impact on something like technology and consumer discretionary. And those are the two sectors that really, from an EPS perspective, are at the most risk of seeing downgrades, at least in the U.S. So, yeah, that's back to your point. 60 is still a high level. We are expecting something higher than a 10% baseline sticking around for China, but 145 is really not baked into our updated views post-Liberation Day.
Drew, hi. Great to be speaking with you today. And I guess that explains why you folks at Citi have cut the rating on, I think, U.S. equities to neutral, right? Because the EPS tailwinds and the GDP strength, all that, as the note says, will perhaps be fading now. But how severe could it be? What exactly are you expecting in the U.S. market? And the reason I'm really asking is that I know that India is an overweight for you within the EM basket. But in the past, when there's a big slowdown in the U.S. or the U.S. market really falters, most emerging markets tend to suffer. Could there be a decoupling of sorts this time?
To some extent, yes. But what's really interesting in the regional calls out of our global team is you're thinking about buying cyclicality outside of the United States. So select emerging markets, like you talked about, Europe, Japan, different areas, again, for cyclical and value stocks. Why we're still neutral in the United States and not moving all the way to an underweight here is there are still very innovative companies that are very well run that are still going to have good earnings growth. So the risk at this point is being underweight or not exposed to high margin, high quality US companies that can bear the brunt of tariffs. And again, seeing those stocks move like we've seen in the last few days on some conciliatory tone on trade. So yes, we've downgraded the United States as a team, but we do see the risk of not being exposed to really good secular growth stories still. So it's selective in the United States. That's why it's in neutral.
All right. Hi, Drew. Good morning and good to see you. When, a lot of our audience would like to know what about within the emerging markets, how are you betting between India as well as China? Because China is going to be hit harder as per what we have on the table right now from the US tariffs, while India, we're relatively better placed. So between the two, India gets pole position. Would that be the way we look at it?
Yeah, it sure is. Look, India, from a trade perspective, less exposed. So number one, very important when we're thinking about tactical position in EM. Now, number two, India also has a really good at-home macro growth story. So you still have that tailwind in place. So both of those points really push India as an overweight within our EM allocation. China, on the other hand, that's an area where we're neutral. Again, not all the way underweight. There are some kind of structural stories there and maybe less trade exposure for some of the big names within that market. But India does have far less trade exposure from a macro perspective than China does, hence the overweight rating relative to a neutral on China.
Okay, and within the emerging markets, I'm just looking at a note that you put out. It appears some of the LATAM countries as well as finds preference. I think Chile, I think, is one market that you like. Tell us more about that.
Yeah, so I'll give you LATAM. So Chile is our overweight there. And again, this is a really good earnings growth story. So coming off of a low base, working much higher, the cyclicality there probably priced in better than other places, or potential dense to cyclicality. So really good earnings growth story for Chile. Where we're thinking about other overweights in EM, a place like Taiwan, for example, similar story to how we talk about US growth. There's AI and secular tailwinds for some of the big weights in the Taiwanese indices. And then the one cyclical area where we kind of are comfortable in emerging markets is South Africa. And this is a valuation call on something like South Africa, which has probably priced in, the effect of tariffs very aggressively. So again, outside of India as an overweight, we have Chile for an earnings growth story, Taiwan for the AI tailwinds, and South Africa because it's already priced in a lot of bad news.
Okay, got that. So, a lot of equity calls changing, and that's given the uncertainty that we're living in the midst of. Thank you very much, Drew, for joining in. Appreciate you giving us that perspective today. So there you have it. That's the City View coming in on lots of calls changing, actually. But the good news for us is that within the Asian region, Japan is an overweight for them, India remains an overweight, and China is a neutral.
What was the number, guys? The FI number yesterday?
3,333 crores. Quadruple three.
Stomping back into the market, but still a fraction of what they sold, right? I mean, I think that's an important point. So this is a sort of slightly looks like a global kind of repositioning of India within whatever EM funds, or we'll get that perspective from EPFR, etc. as well.
6 straight sessions, I think so. Good.
So last week was 3 days. It was 50,000 crores, and this week would be
so far 3
plus
days.
What? I mean, so we'll have to see.
Today's the 4th day. We'll see.
It should be what, 25, at least 25,000 crores.
22,000 crores, I think.
Over the last 6 trading sessions or so. Well, let me quickly run you through what's lined up here in terms of the interactions over the next 2 hours or so. 8:35, Aditya Khemka, Winfred Asset Management. Talk shows about pharma. And we'll talk specific stocks with him. Lots to discuss. 9 o'clock, Sandeep Agarwal, IT analyst, ex-IT analyst, Sovelo Investment Managers, but IT is the focus on the back of earnings. 9:20, Dheeraj Agarwal of Ambit Investment Managers will be with us. Market Master, 9:40, we'll have a discussion on autos. So, we'll have 2 gentlemen to run us through the Aether IPO, which opens early next week. And of course, what's happening with Ola and the entire EV ecosystem. Our sort of excerpts of the conversation my colleague Shireen had with the management of Tata Power at about 9:50. And towards the end of the program, it's the Economy Lata in conversation with Stephen Major, fixed income expert at HSBC on expected trends in dollar and US, and of course, yields here as well.
Well, time to slip into a quick break. We got a lot of stock-specific action to track for you. On the other side, in our special Top 10 segment, we're looking at Tata Consumer, LTI Mindtree, Canfin Homes, Persistent Systems, Dalmia Bharat. All of them will be reacting to positive news flow. We had Biocon as well as Sami Hotels. But on the flip side, you have Bajaj Housing Finance as well as Syngene and Spandana Spurti that will be reacting to negative news flow. Slip into that break, come back, we'll get into further detail.
Welcome back. So like we've been telling you, cues across most Asian markets, barring Hong Kong, are actually pretty okay. There are some gains in Asia. Let's get the markets up. Yeah, the Hong Kong markets, not feeling too great this morning. Let's pull up the implied open. I mean, considering our run, this solid run of 7 straight sessions of gains, the implied open is suggesting that today there could be a bit of a halt on that, 47 points lower at this point. Well, apart from all the global cues, of course, lots and lots of earnings and stock-specific action to go over. So let's straight away get to it. Our team is standing by with the CNBC-TV18 list of top stocks to watch. Guys, good morning to all of you. First, let's recap the big earnings, then we'll come to the others. Mangalam, Tata Consumer, how did it look?
Well, it's largely in line with expectations, a few bright spots in Tata Consumer. So if you look at the revenue at 4,600 crores, the street was working with a number of 4575 crores. The EBITDA, despite a 420 basis points drop in gross margins, it actually improved versus expectations. So 621 crores versus expectations of 600 crores, which meant margins came in at 13.5% versus 13.1% as well. And the net profit was a beat led by, better than expected EBITDA. But more importantly, there was a 45 crore exceptional gain that came in as well. India Beverages, organic revenue grew by about 9%. The street was working with a number of 10 to 12%. But look at foods. There, the organic business was close to 17% in terms of growth. The street was working with low double digits. So that was an outperformance out there. Narishco as well. We were working with 8 to 10%. 10% is what the company reported. That's a positive. And Capital Foods in Organic India, the acquisitions that they made did about 320 crores in revenue. Again, better than as expected in the performance. International business, 5% revenue growth led by US and UK. We had non-branded businesses that did extremely well, 25% higher, led by higher realizations in coffee prices. The stock has done well this year, 24% higher this year with, trading at around 55 times FY27 price to earnings. So it's priced to perfection. So see mild green despite, numbers which are slightly better than expectations.
Okay, all right. Thanks a lot for that, Mangalam. Well, let's hop across to Rima. She's here to tell us about a couple of tech names. LTI Mindtree. Rima?
Well, LTI Mindtree was largely in line with expectations. The company's top line declined by 0.6% quarter-on-quarter. EBIT margins unchanged at 13.8%. The company said the quarter was impacted as ramp-ups of deals which closed in Q3 got delayed, and even some new fresh deal closures got pushed out. That said, in the conference call, they did say that they're hopeful that Q1 is now a growth quarter. Clients were cautious in Q4, but some conversations have started in Q1, and the company is hopeful the deal closures will happen in FY26. So Q4 muted on expected lines. Commentary about the upcoming quarter and the year seems to be a little more optimistic.
All right, Rima, thanks very much for that. So keep an eye out on this one as we open up. Bajaj Housing Finance and Canfin Homes are the next two in focus. Abhishek is here with details. Abhishek.
Well, Prashant, to begin with, Bajaj Housing Finance, the numbers are below analyst estimate. P&L versus Kotak Securities estimate does show that NI and PAT is below Kotak Securities estimate. Disbursements are strong at 25% growth YOY and about 13.5% sequentially. However, disbursements to AUM ratio has declined, and for last 4 quarters in a row, it's been on a declining trend, which suggests that the tenure of the book is also declining. AUM growth is healthy at 25.5% YOY and nearly 6% quarter-on-quarter, but they have lost out on spreads over the last few quarters. So spreads has declined to 1.8% versus 2% in the same quarter last year and about 1.9% in the previous quarter. Well, Canfin Homes, the P&L is ahead of analyst estimate, which I've taken into consideration. That is DAM Capital. NI is at 348.5 versus 345.7 crores estimate. PAT is at 234 crores versus 221 crore estimate. Net interest margin has surprised positively. It's at 4-quarter high of 3.82%. Disbursements have started to pick up. Sequential growth is at 30.65%. Remember that in Q3, there was a blockage with respect to registration in the key cities of Bangalore as well as Hyderabad. So AUM growth has picked up 9.2% YOY and 2.9% sequentially. The return ratios are robust with ROA at 2.6% and ROE of 18.5%. And if you check, the asset quality has also seen a seasonal improvement over here. Gross NPA ratio has declined to 0.87 versus 0.92% in the previous quarter. Back to you.
Okay. All right, Abhishek. Got that. Thanks very much. Let's get back to Rima. Rima, Persistent Systems. How did it fare?
Well, very good growth in Q4. So the company reported a top-line growth of 4.5%, slightly ahead of consensus expectations. And also bear in mind that most of the companies in Q4 have reported a top-line decline. And this is a company which has grown 4.5% in Q4. And for the full year, Top-line growth stands at 18.8%. EBIT margins have expanded to 15.6% on expected lines. Deal wins are a bit subdued sequentially. If you look at the total contract value, the new wins, across the board, deal wins are down quarter on quarter. But the company, in their commentary, says that as we look ahead, we're optimistic about sustaining progress to reach $2 billion in annual revenue by FY27. So despite the uncertainty, they're reaffirming their guidance of $2 billion by FY27, and growth continues to be superior than peers.
Okay, all right, Rima. Thanks a lot for that. Well, I'm focusing on Dalmia Bharat, and the numbers are pretty okay. And the outlook should be better. That's why I'm going with green. No big shakes in the numbers, but I'm going with green because the outlook should be better from here on. These numbers are more or less in line. On the top line, a small miss. Why was that? Because realizations were expected to go up on a sequential basis, didn't play out for them. Also on volumes, it came down by closer to 3%. That's on expected lines because in the base year, there was tolling volume coming in from JPA, which wasn't there. Adjusted for that, actually, there was a mild growth in terms of volumes. Moving to the operational performance, actually it was in line. You'll be wondering how. Because there's no operating leverage that played out. They didn't get the benefit of higher pricing as well, but they benefited on the cost side. So the cost of power and fuel as well has come down, which helped them on the operational performance. And just one factor that we'll be waiting by for clarity on is the other expenditure came down sharply. So that's what led to the EBITDA per ton moving up from around that 750 odd mark. It went up all the way to around 926 rupees per ton, which is a positive. The net profit number though looked much better. Effective tax rate was lower and depreciation was sharply lower as well, which explains why the profit number looks much better in comparison to our poll. They've also laid out a capex plan of close to around 3,500 crores as they're looking to add capacity. And now the debt number has come down to only around 700 crores. So balance sheet in pretty good shape. Going with green because the outlook should be better from here on. But there's a big deal that's announced earlier today, and Nimesh had given us a heads up about Sami Hotels. Mangalam joins us to help us out with those details. Mangalam?
That's correct. You know, Nimesh had told us in D Street Chatter, and it's come true. It's announced a strategic deal with GIC where GIC will acquire 35% stake in 3 of the company's subsidiaries for about 752 crore rupees. This values that business at an enterprise value of close to 2,200 crore itself. And these are just the 3 subsidiaries of the company. They will use 603 crores of this to reduce debt. Remember, in FY25, their net debt is close to around 1,500 crores. So their debt comes down by that. And the remainder, 149 crores, will be used to fund capex in a couple of their marquee properties as well. The company said that on closure of this deal, their debt will reduce by about 580 crores. And their profit will increase by 15 to 20%. So this is obviously a good exercise when it comes to value unlocking and improving their balance sheet as well. How much of that is priced in will be the big question, because in the last fortnight itself, the stock is up around 23%. But it is strong tailwinds for the hospitality industry. Expect the stock to see some more green on the back of this deal announcement.
All right, Mangalam, thanks very much for that. So Sami is a stock you must have on your radar as we open up this morning. Syngene and Biocon. Vinny is here with details on these numbers. Vinny, over to you.
Good morning. So Syngene, a weak set of numbers that came in from the company in Q4 FY25 and overall for FY25 also, it was a very subdued year that came in for Syngene. Now in terms of revenue, especially for Q4, 11% growth in terms of revenues. Margins have seen a contraction this time. 33.7% is what the margins came in at versus last year 34.5%. Mainly pressure on the margins was higher employee cost. Overall change in mix is also something that is impacting Syngene's margins. So a bit of a subduedness that we saw in terms of margins. Profits of the company have seen almost a 2% decline as well this time. Now revenue growth this time was mainly only supported because of the CDMO side of the business that was doing well. Commercial projects were there and there was a conversion in terms of inquiries that came in for the CDMO business into clients. So that was a bit of a positive on the CDMO business side, but other than that, muted performance. Now what's taking a bigger hit and why are we expecting red here is the guidance for FY26, a very muted guidance that is coming for FY26. Despite this being a year where we are seeing muted performance as a subdued year for the company. So FY26 revenue growth, they're expecting just a mid-single digit revenue growth there. Base business also is seeing a growth of early teens is what they're expecting in FY26. EBITDA margins expected to moderate, profits expected to fall from these current levels as well. So FY26 not expected to be a great year. Biocon, on the other hand, we're expecting green coming in here. They've announced a raising of around 4,500 crores. This is going to be through issue of securities. QIP's right issue could be a possibility over there. So keeping an eye out on Biocon, expecting green here.
Okay, so Biocon green, Syngene maybe a little more red. Got it, Vinny, thank you very much for that. Back to Abhishek. Abhishek, Spandana Spurti, the MD and CEO has resigned?
Well, yesterday in trade, you saw the stock decline massively despite the fact that Nifty was up 0.7%. So now we know the reason. Spandana Spurti has seen their current MD, that is Shalabh Saxena, place his resignation. He'll assist the company during his notice period. The president and CFO, that is Mr. Ashish Damani, has been nominated as the interim CEO to take over the reins during this notice period. The con call that they had for analyst community yesterday evening, he did say that they'll raise money of about 500 to 750 crore post the Q4 FY25 results, and this will be confidence capital as the CRAR, that is capital adequacy ratio, is already at 35%. Now, the MD also did mention that he had been contemplating this move since last 6-7 months about the resignation, and now he's placed resignation at the company. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, let's do a quick recap of all the top stocks that we covered for you, the ones with positive news flow first. Tata Consumer, LTI Mindtree, Canfin Homes, Persistent Systems, Dalmia Bharat, Biocon, and Sami Hotels. While the ones with negative news flow include Bajaj Housing, we have Syngene, and Spandana Spurti. That's about equities. Let's turn our attention to the commodities market. Manisha Gupta joins us to tell us more what's going on there. Well, Manisha, when I woke up this morning, gold was down, but that was short-lived. Popped back up. Tell us more.
Oh, well, absolutely. Every dip is getting bought into. You're absolutely right. We saw an all-time highs of $3,500 an ounce. And from there, gold saw profit-taking, went to 3,260 on the lower side. It's trading at 3,340 right now. So, well, absolutely. $60 to $100 of a move coming in every day in case of gold prices there. Well, the dollar index is off its 3-year lows. There's a bit of a rally in equities. And the U.S. has expressed potential lower trade tariffs with China. That is what is keeping the gold prices in check right now. But various banks and brokerages who had earlier talked about 3,500 with that target done are talking about some profit taking in the near term. But they do expect that the year 2025, calendar year that is, will end with all-time highs in gold yet back again. What we are also seeing volatility into is the crude oil prices. Fell 2% overnight. Crude is, by the way, down 10% on months now. There are various statements from OPEC and allies suggesting that there could be an increase in output, not just for the month of May, but even higher for the month of June. And then the U.S. crude inventories also have seen a bit of a decline. Markets also are looking at potential trade negotiations with China. So all that premium that was building up in case of crude prices also seems to be going away. The only thing that actually has made a mark in the overnight trade has been the silver prices. 3.5% of gains overnight and continues to surge in Asia even now.
Right. Manisha, thank you very much for that. You know, that snap, gold lower and then gold lower last night, gold higher this morning. I think the difference is China. China woke up, Chinese markets opened. And actually, that's been true for the last couple of days now. So demand out of Chinese markets quite very, very strong. And that kind of explains the pop higher that we saw early on. We'll take a quick commercial break here. We're going to come back. Aditya Khemka of InCred Asset Management talks about stocks and stocks on the pharmaceuticals space and what he likes there. You know, this sword has been hanging on the pharma space for a while. These tariffs, sectoral tariffs, right? But lots of individual stock-specific developments as well, which we want to address. Deepan Mehta of Elixir Equities will be joining us as well. So stay tuned. Okay, welcome back. You know, Pharma in Focus, right? Aditya Khemka is now with us, a fund manager at InCred Asset Management. Aditya, good morning. Good to have you back. Prashant here. Yeah, I want to start with what is the hottest topic of discussion? I mean, if you are in, if you're talking to your GP or doctors, etc. I mean, I've been GLP-1 and all of the excitement around this new oral drug of Eli Lilly. Right? And decently high efficacy in terms of course, the test was for type 2 diabetes. The obesity longer run tests will now happen. But still, even in this, 8% weight loss, etc. So very effective in that sense. What are the implications for Indian listed stocks here? There's a Citi note this morning, Aditya, talking about how, Divi's perhaps is the big beneficiary out of this. So talk about that, Divi specifically. And second, talk also about two other companies. One is OneSource, there's one more company, right, which Shelly Engineering. So one does fill finish, the other does sort of plastic components. So these three names to begin with. Aditya.
Yeah. Thanks for having me, Prashant. So firstly, just to be very clear, I think the GLP-1 market is going to be extremely competitive. And, there might be players who will be, the first movers for the first 6 months or 1 year, but then, there'll be a whole bunch of companies jumping into the market, especially where the injectable product goes. So your fill finish players, your API manufacturers like DVs, they will all have, significant competition over a period of time. But yeah, initial 6 months to 1 year, they might have some sort of exclusivity window where they'll make some money, but then the revenue stream dies off. So as an investor, when we look at cash flows, we don't look at 6 months, 1 year cash flows, we look at 3-5 year cash flows. And there, our estimates don't really change because you have these one-off kind of opportunities hitting the P&L and, helping you in any form or fashion. As far as Eli Lilly goes, yes, the innovator might make some money out of this because it's an oral drug, and the oral drug, therefore, have a much higher ability to penetrate the market than the injectable does. And yes, so Indian branded generic pharma companies, they might in-license the drug from a Lilly and they might sell it, with their own brands on the label, and they can make some money on that side. But as far as the manufacturing side goes, be it Divi's, OneSource, Shelly, and many others, who are claiming to be a participant in the GLP-1 markets, I would not have very high hopes for them.
But why is that, Aditya? I mean, it's a big market. It's not just weight loss, right? There are studies which are... I'm just want to clarify, it's such a controversial topic, right? I mean, and doctors get all riled up when you ask them. Some are strongly against it, saying, well, what about the long term? These are new drugs, side effects. I don't know. We're not medical doctors. So there's no opinion on whether one should take it or not. But purely from a business standpoint, there is the obesity part, but also there are studies which show, it's effective in treating so many other ailments. Neurological, for example, etc. My question is, and these companies are... So I have a specific 2 or 3 questions. One, will oral dent in the injectable GLPs? That is one, in your opinion. Second, if it's going to be the biggest drug ever, globally, I mean, this category of drugs, why won't it be a lasting revenue stream if Indian companies are able to get into various parts of it, either the components or the fill finish?
Exactly. Yeah. So first of all, will the oral be better than the injectable? Given that everything else is the same in terms of side effects and efficacy, yes, oral will be more successful than the injectable. But that's subject to the side effect profile and the efficacy profile, which I don't think we have a head-to-head comparison yet. So it's too early to call that. But if it is the same, then oral will definitely be more successful commercially than the injectable product just because of the ease of dosing, right? Now, why, we don't expect the manufacturers or the Indian pharma companies to be beneficiary in the longer term? Because in manufacturing of pharmaceutical products, it is never the demand, the size of the demand. It is the size of the supply that dictates how much money you make. So the demand can be 100 units, 1,000 units, 1 lakh units. If the supply is 150, 2,000 and 5 lakhs, then nobody makes money. And I think that is exactly what GLP-1 is going to be, because no matter which pharma company I speak to, GLP-1 is the first growth driver they talk about. And that's what tells me that nobody's going to make money. Let's take a journey back to 2011. Atorvastatin, Lipitor, was the largest selling $14 billion drug in the market back in those days. And nobody made money. Only Divi's and I think only Dr. Reddy and Ranbaxy and Teva made money for 6 months. And then nobody made money out of atorvastatin. So I think it's pretty much going to be the same thing here.
You think, so again, to take off on that point, do you have specific numbers on the capacity? You said supply more important than demand. Do you have size of supply right now? For example, let's take this, the components, for example, or let's take the API, which DVs will get into.
Yeah.
All these companies, this is all anecdotal, right? They all are excited, but are they really being able to do anything about it? Because Eli is not going to work with everybody, right? So it's hard to kind of get on board with in-licensing or whatever as well.
Yeah. So look, none of these pharma companies will call out their capacity for a given drug. Many of their capacities are generally multi-purpose. So they can be used for a given drug or other drugs at any point in time. And hence they cannot sort of call out a dedicated capacity for a given product or a given therapeutic segment. and hence, we do not know how much capacity is chasing the demand here. But what we do know is that the number of companies chasing it is very high. So even if each individual company on an average has a certain capacity, then it will outstrip the demand. And this is not new. This has happened at least 5 times in the past 20 years that I've been looking at pharma. It happened with aripiprazole, it happened with pantoprazole, it happened with atorvastatin, it happened with rosuvastatin. So we have seen all these large multi-billion-dollar drugs translate to nothing for generic players over a period of time. Initially, they do contribute some number, but then they translate to nothing. It's happening to Revlimid as we speak. Look at what happened to Natco in the last quarter. It's just the nature of the beast. You cannot make money in these large drugs because of the large number of players who are interested in these drugs. And then, when you come to the marketplace, it's cutthroat competition. Nobody ends up making money in the long run.
Okay, got that. Let's talk about two other names. One is Lupin. There is this big drug going off patent, a big opportunity. So any thoughts there? And then just run us through, if you have any thoughts on Syngene, pretty poor numbers.
Absolutely. So let's take up Lupin first. I think the drug that is going off patent, Lupin has a play in it. But that is already part of our estimates for Lupin. So, it's not over and above what we were expecting. So let's see, how the business sustains. But again, Lupin has a limited competition window there, and after that there will be competition. The drug will not be a sustainable revenue stream for Lupin as well. So that 180-day exclusivity that they have, that is basically the period where they will make some extraordinary money, and then it will fizzle out. And such revenue streams and profit streams cannot be given a multiple simply because it's a half-year revenue stream. It does not deserve a multiple. Now coming to the second company, which is Syngene. So in Syngene, I think what has happened is that the order flow that they were expecting has not been up to the mark. They have maybe lost a couple of customers or some orders from a few customers because, these customers have opened captive centers here in India, and hence switching some of the demand from Syngene to their own captive centers. And that is something which is sort of creating a challenge for revenue and margins in the near term. Having said that, from a longer term standpoint, I'm not so worried about Syngene. Again, it goes back to sustainability, where we feel that, the China Plus One is clearly something which is playing out. Syngene is a front runner in the Indian CRO CDMO space and should eventually benefit. What we feel is that the current environment and maybe even the next 2 or 4 quarters, you may be looking at Syngene as more of an aberration than the rule. And I think once they get their act together, definitely there has been some mixed execution at the company's level. But once they get their act together, I think the demand in the market is too big for them to sort of grow in single digits. They will definitely come back to double-digit growth, subject to them getting their demand, their act together.
All right, Aditya, a quick conversation. Thank you very much for joining us, and we'll have more of these as we go along and we track developments, especially on the GLP-1 side. We take a break. Deepan Mehta on the other side.
Welcome back. Hope you're having a good morning. For starters, the GIFT Nifty was suggesting a bit of a flattish or mildly negative start of close to around 40-50 points. So they're about 60 points now is what we're bracing ourselves for. But plenty of stocks, a lot of action. Deepan Mehta, Director at Elixir Equities, joins us on the show. Hi, Deepan. Good morning. Good to see you. When few good earnings came out overnight, case in point being a Tata Consumer, though the stock has jumped up. And also we had positive numbers coming in from LTI Mindtree and Persistent System looked very, very good. Among the three, do you like any of them?
No, Nigel, none of them. If you call 2-3% type of a growth as good, I don't know, what is good then. So whether all the tech companies, the results so far have been disappointing, except maybe for Persistent System, there also eventually growth will slow down because of base effect and the uncertainty. So I think it's time to get extremely cautious on the software services company. And what is even more disappointing is that the management say that a 2-3% type of a quarter-on-quarter growth is a strong quarter. Means what has happened to the ambitions of the software services companies which were driven by entrepreneurial spirit? Now they are more than happy with a mid to high single-digit growth in sales. So I'm just very disappointed with the sector as a whole. And there are a lot of secular headwinds. This GCC is going to play a big role in reducing their growth rates. And of course, there is this entire sword of slowdown in US, which may affect tech profits. So we are getting more and more underweight on the software services side. There could be a few exceptions, companies which have a differentiated business model. But by and large, don't get enthused by a 2-3% outperformance versus what the analysts are expecting. And just because stocks are cheap. So I would still avoid the sector completely. Tata Consumer is good, but look at the valuation. I mean, the PEG of 6-7 times or so. You can't get solid money or get great returns or wealth or build wealth through Tata Consumers by buying at these levels. That's my conclusion.
Deepan, that's on Tata Consumer. Of course, today lots of other consumer companies are also reporting. Nestle is reporting, Lever is reporting. We all know, I mean, there's no growth there either. But, maybe they're not as expensive as they used to be. Would you look at any consumer stocks at all on the FMCG side?
Yeah. Good morning, Surbi. The biggest mistake I have made in life is to buy stocks which are cheap. And because they have corrected and valuations have come out, because the valuations have come out because there's something fundamentally wrong. And in the FMCG sector, a lot of categories have become mature. The growth rate, the underlying volume growth rates of many of the FMCG products is now linked to the population growth and not the GDP growth rate. And that's a very important distinction because you're in a country where you have a nominal GDP growth rate of 10% plus. Then why aren't these companies growing at 12-13% or so, or growing at 4-5%? That's a question you have to ask. And the reason for that is that the penetration levels have reached deep. All the benefits from getting into the rural areas is now over and done with a lot of these companies. And end of the day, I think consumer spending on FMCG products as a percentage of their income has remained static or gone down. And now there are many more avenues for the consumer to spend, be it in retail, travel, hospitality, healthcare, education. There are many more needs. And the Indian consumer has fast changed than what he was about 20 years ago.
I call it the mid-single-digit jinx, Deepan, because that's what this whole sector and many of these companies have been in the severe grip of, this mid-single-digit growth. Will it be any different for Lever this time around? Since we're on the subject, let's bring in Mangalam and get the expectations going. Mangalam?
You call it the mid-single-digit jinx, and will Lever be any different? Yes, it will be, because it'll be low single-digit and not mid-single-digit this time around. Demand conditions are very similar to what they were in the third quarter. 0 to 1% domestic volume growth is expected, not too much. 2% underlying price growth, and that's largely because of palm oil prices increasing, and at the same time, tea prices increasing as well. So there would be that portfolio-led price increase, and the company will navigate through their margins by reducing their ad spends from closer to 11% of sales to about 9.5 to 10% of sales itself. Put all of that together, what do you expect for Unilever? A 2% revenue growth, 15,161 crores. EBITDA grows at 2% as well, with margins staying stable at that 23.1% mark itself. Net profit higher by about 3% at 2,475 crores. Personal care segment likely to grow between 0 to 2%. Beauty and wellness, which is a category which has been growing fast. We've seen that in the case of Nykaa as well. Likely to grow much better than the overall portfolio at around 4 to 5%. So that's mid-single digit growth for you. Home care and food expected to grow around 2 to 3% or 0 to 2%, depending on the way you look at. More important than the numbers this time around would be the management commentary on scaling up of operations and what their expectations from FY26 is when it comes to urban demand in particular.
2% volume growth, Mangalam, right? That's what you said, overall 2%.
0% volume growth and 2% revenue growth. 0 to 1% volume growth.
0 to 1% volume growth. When a giant like Lever, with its muscle and might, its distribution power, its marketing power, tells you there's 0 to 1% growth, and this is all across the country. It's pan-India growth that we're talking about.
Yeah.
Through channels, I mean, e-commerce, direct, kirana, everything put together, 0 to 1%. That's telling you something, that the market definitely is listening.
Well, indeed. Deepan, I wanted your view on a sector that could grow, though, going ahead. Dalmia Bharat. The numbers are pretty okay. I think after a few years, the last time we chatted, you were sounding at least a little bit more interested in the cement names. It's domestic facing. Cement prices have moved up. Input costs have come down. Quarter 1 should be better than quarter 4. Anything you like from the cement pack? And if you had a closer look at Dalmia Bharat's numbers?
Yeah, Nigel, we are getting constructive on the cement sector. I think it's in a nice cyclical upswing after 2-3 years of downswing. And Dalmia Bharat being the 4th largest cement company certainly should do pretty well. Bit disappointed with the volume numbers because the growth in profits has come through lower costs. Typically, we want the volumes to go up in the cement industry to get more and more confidence in the sector. But yes, I think given the kind of construction activity and so many real estate projects have been announced, they should start getting into construction phase as well. And with the elections and all over and done with, execution also will pick up. So we are very positive on cement. The favorites over here with usual disclosure that we and our clients are invested are the Adani Group company, that is ACC and Ambuja, where they can squeeze out more efficiency, especially in ACC. And they're very aggressive when it comes to M&A activity. The group itself is a captive consumer, and they have great plans for these companies, and valuations are reasonable below the other larger companies, be it Ultratech or even Dalmia Bharat or Shree Cement for that matter. So there's at least a slight opportunity of a P getting re-rated higher. So generally positive on cement, I think, and I think that these two companies will outperform the rest of the market.
Valid thought, Deepan, and good to hear after a while you're getting constructive on the cement space with good reason, as you explained that to us. Stay with us. For the time being, we slip into a short break. Come back. Our technical experts will be joining in as well.
Welcome back. Just about 15 minutes to go before we hit the pre-open session. Good time to bring in our technical experts. Actually, not the pre-open session. I meant the open session. We're already close to 9 o'clock. We have Sudarshan and Mitesh joining in, as always, with the technical setup. Gentlemen, good morning to both of you. So the market is in cruise control mode nearly. Yesterday, banks took a bit of a pause, but then other sectors made up for it. Sudarshan, so what would your sort of trading direction be, and specific index calls first?
Yeah, good morning. See, my trading direction would be completely away from the market. Yesterday, I suggested that we are getting a gap up. Use that gap up to close all your long positions. And I think that view continues today. This doesn't mean the market is going to turn down or we want to go short, far from it. What it means is that markets will become choppy and sideways. You know, a trader will always find it difficult to trade choppy markets. So it's much better to step aside. Wait for a couple of days, 3 days, whenever the markets start giving signs of life again. I would expect a lot of choppiness for the next few days. So stay away, cash in your profits on the long side and just watch it.
Okay, all right. Cash in your profits on the long side and wait by. Got it, Sudarshan. That's your take. Mitesh, what about you? Would you participate on the upside?
Like I've been maintaining a long bias, and I think that still remains. The setup on the short term and the medium term charts is positive, except for the fact that we are slightly on the overbought side, which means that now instead of buying at every moment, every chance, every opportunity, I think you've got to be slightly smarter and you want to wait for some kind of intraday dips to take fresh positions. If you're holding long position, then you can just keep trading your stop losses and be happy about it. But for somebody who wants to enter a fresh, I think any kind of decline, intraday or maybe a 1-2 day kind of a pullback to the 10-day average or to a gap support pivot area, I think would be a fresh entry point. And that's the way we'll approach it. But on stocks, yes, you would still be trading with a long bias, clearly because my belief is that the market is poised to go higher.
By the way, congratulations, Mitesh. Yesterday, we started 200 higher, lost 100, and then I think came back once again. So it was good. I mean, I think he was saying that buy the intraday dip in that sense. Gentlemen, morning. Sudarshan, what would you do in terms of specifics?
Well, Asian Paints is a buying opportunity with a stop under 2410. GMR Airports is a buy with a stop under 85. I have only one intraday short because I'm not bearish on the markets, just choppy. Voltas is an intraday short with a stop above 1335. And finally, ICICI General Insurance is a buy with a stop under 1845. This is a good time to focus on stocks rather than on the index.
Okay. Mitesh, what about you?
I would, have all buy calls today. A buy on Aurobindo Pharma with a stop at 1220 for targets of 1300. a buy on Cummins India with a stop at about 29.20 or 29.23 and a target from 30.60 can be looked at. Alchem Labs is a buy with a stop at 51.95 for targets of 53.20 and also a buy on ICICI Pru. It's a conditional buy. So it's been, making those intraday highs around 610, 611 for the last 2-3 days. Once we start getting past 612, buy with a stop below 600 for a target of 635.
Okay. Let's just look at the dollar rupee as the market is opening up. Mitesh and Sudarshan, thank you very much for that. The pre-open is also kicked off. By the way, the dollar rupee, the rupee basically weakened about 0.3% in the offshore non-deliverable market last night on the back of these sort of, the Pahalgam attacks and, of course, what may follow. So markets very much focused on that as well. So this morning, 85.60 or so on the rupee, dollar rupee, which is coming through. 50 points lower on the Nifty, but this is, initial first 3 minutes of the pre-open session and focus. Let's talk about IT, guys, because the index was up 3% yesterday.
Yeah, big pullback on the IT side of the market. And I think we have a guest.
Well, that's right. Let's get straight to it. We have a lot of numbers that come in there. And the good news is the last couple of trading sessions, we have got some positive surprises. HCL Tech delivered a fairly good set of numbers. The index was on fire yesterday. And you have LTI Mindtree as well as Persistent System that did quite well. Sandeep Agarwal, fund manager at Sovilo Investment, joins us on the show. Hi, Sandeep. The stocks pulled back a goodish bit. Yesterday, the index itself was strong. But these numbers coming from Persistent in particular looked quite good. What's your view?
Yeah, hi, good morning, and thanks for having me on the show. So, to start with, Persistent have been delivering quite well for the last several quarters. And, I think they have got the very good grip on the ER&D piece of the business, and they have been delivering on top of that. So I think that is an exception. If you see across the board, they have been delivering quite robust number for several quarters. And I think, they have good client stickiness and consistent flow of deals. So that is a very good number, to be honest, in this environment.
So, Sandeep, hi, good morning, Surabhi here. So, what's the overall way to play this? Companies like Persistent, even Coforge, they've anyway been coming out with industry-leading growth, right? They've done so much better. Coforge, 30-35%. Persistent last year grew at 18%, still sounding confident. So do you stick to these names or would you perhaps be looking at even IT services because of, I don't know, maybe valuation comfort, cash levels or something like that? Because growth clearly is still missing.
So, what has happened is with that, you see IT has underperformed massively in last few months and now they have come to a level where some of the large caps are now at 4.5 to 6% dividend yield. And, across the globe, there are many funds, dividend funds, which have very limited options to buy for dividend stocks. And for them, these stocks now have become quite attractive. And because of that, you would have seen the kind of movement you saw yesterday. In fact, in last 7-8 days, most of these stocks, whether TCS, Infosys, they have moved up almost 10 to 12%. And this is primarily because of the FCF yield. But as you rightly mentioned, growth, I think, will be very challenging. And remember, in IT, 80% is top priority, which cannot be changed, delayed, postponed, nothing. Balance 20% is last priority. It is discretionary. So it only comes when environment is extremely good. So I really believe that, for the IT services firm, growth this year will be challenging. For large cap, 3 to 5% is also a very tough ask. And for good quality mid cap, even low double digit will be challenging. So given that scenario, the PEG ratios are between 3 to 6-7 times. So I don't know whether that kind of PEG ratio should be assigned to a sector which is growing at such a low rate. So that is my concern. So valuations are still not very reasonable, to be honest.
But within this universe, would it be mid-cap IT over large-cap IT? And names like what Surabhi said, Coforge, etc. Coforge, for example, reports over the weekend. So if, these companies say, well, deal pipeline is looking pretty strong and, they indicate, you think there is still a price dislocation, which is there between, because stocks sold off from 10,000 to about 6,000. It's come up now, of course, 20-25%. What's your sense?
So, as you mentioned, Persistent in the ER&D has been delivering very solid numbers. And similarly, Coforge in the services side has been delivering quite good number. But my concern is that, in ER&D, there is a different reason why the stocks were doing well. And I think they will do much better than IT services in long term. But given these challenges which we are seeing, early signs of challenges in the auto space in Europe, I think, even ER&D can have a lag effect. So remember, these are very long-term deals and it takes time to slow down and it takes time to pick up. So I would not read too much on just quarterly number. In my view, the pickup will also show first in the large caps, which I don't think will happen in first half of FY26. So I think there is some slowdown which you will see in this good quality mid caps, which are still giving good numbers, and these are on back of the past orders which they're executing now. So I think some slowdown in good quality mid caps is yet due. And the large cap, I think they will be the first one to start reporting good numbers, but they are also at least 2-3 quarters away. That is what my sense is. So I think, we have to be very careful. Where there is 5.5-6% FCF yield in large cap, probably they would have been closer to bottom. But otherwise, I don't expect too much on growth this year.
So that means that since you're saying the auto sector is unlikely to offer any respite to these ER&D companies, I'm looking at Tata Elxsi. Let's get long-term charts in, maybe one-year charts. Tata Elxsi and even KPIT. The stock, Sandeep, interestingly, in the last 3-4 weeks, started showing some signs of life, even as this whole tariff storm was surging around. Now, let's pull up a 1 year. Look at the value destruction. And then this little excitement building up, pretty much in the last 2 weeks. You're saying this is a bit misplaced for stocks like Tata Elxsi and specifically KPIT Tech?
So I will not call out any name because we run a PMS, but let me put it this way that, I believe that auto will give some pain to ER&D companies. And when that pain comes in, as I said that, right now they are executing what they have won in the past. So going forward, I think there will be some slowdown in all these companies which are in the ER&D space, and even the IT services, the growth which you have seen in some of the mid caps, which was very high. I think that will pull off a little bit. See, large cap, you see the impact immediately, because in large cap, what happens that, they have to get that 20%, and that 20% discretionary is a very big number. But for mid and small cap, it takes time to show the, to bring down the growth, and it takes time to pick up the growth. So I think, first sign of any recovery in growth will show up probably in second half of FY26 by large caps. And after that, 1 or 2 quarter lag, maybe, good quality mid caps will start showing you growth. So I think at current juncture, if anyone has to, seriously look at it, then the only parameter to look at will be the free cash flow yields, which wherever you have 4.5 to 6% range, maybe investors will start nibbling there. But I don't see any other growth reasons to buy the stocks right now.
Okay. All right. Sandeep, we'll leave it on that note. Thanks very much. Good to have that perspective. Stock prices do these things, those, pretty big moves, flash in the pan kind of moves that we've seen earlier this week, yesterday as well. But some longer-term perspective always helps. Thank you very much for joining in. Time for a 9-10 calls. Let's quickly look at what the index is doing. 51 lower, very much in sync with what the implied low, open was telling us. Bank Nifty is also down about 0.5% at this point. So, Darshan, what would your 9-10 call be?
That will be ICICI General Insurance by ICICI GI with a stop under 1845.
Okay, ICICI General Insurance, got it. Amitesh, your stock.
I'll go with a buy on Alchem Labs for targets of 5,300 to about 5,320.
Okay. All right, gentlemen. Thank you very much for joining in with those calls. Let's also put the spotlight, obviously, on the biggest national story of the hour, and an extremely important one. The union government has convened an all-party meeting later this evening. It's probably going to happen this evening, and this is in the aftermath of the attack that left 26 people dead and several injured in Pulwama. There was a Cabinet Committee on Security meeting last evening, and some very, very strong diplomatic actions were announced at the end of that meeting. Parikshit is joining in. Parikshit, I mean, it's pretty historic, right? The Indus Water Treaty in abeyance, Pakistani nationals being told to leave the country in 48 hours. What are the next steps? What does today look like?
Well, Pakistan charged the affairs. The top diplomat of the Pakistani embassy here in New Delhi was summoned last evening. He was handed over papers asking him to make sure that the defense attaches of Pakistan and India, the military attaché, the air attaché, the naval attaché, all of them leave the country in the next 7 days. So literally, they have been expelled from the country along with their 5 support staff. SARC visas for Pakistani nationals, they have been suspended as well, even those which were issued earlier. So all of that have been cancelled, and all those nationals who are in the country, they have to leave in 48 hours. The Atari checkpost, which is used to cross over into Pakistan and for Pakistani nationals to cross over into India, that has been shut down, and all nationals from both sides have to return as well. So we are looking at diplomatic measures. We're also going to see perhaps more action in the next 2 to 3 days. India is deliberating on various options on how to isolate Pakistan diplomatically. We've got an outpouring of support from various countries, including the US, including the European Union. And India is going to use that support to somehow expose Pakistan and export the linkages, the direct linkages with the Pakistani state as far as this terror attack in Pahalgam is concerned. The Indian government is saying it is very clear that normalcy, economic prosperity was returning to Jammu and Kashmir. Successful conduct of elections is something that has not gone down well with Pakistani state actors. And perhaps this is the reason why Pakistan has sponsored this terror attack. And it is clear from the manner, the modus operandi used by the terrorists, they were not locals. The fact that they were asking for identities of the individuals means that they were not from here, and they could have possibly been members of the Pakistani armed forces or Pakistani commandos as well. So a multi-pronged strategy. Pakistan itself is going to hold a meeting of its National Security Council. They are going to retaliate with similar measures, diplomatic measures that India has taken. So let's see how the ball rolls from here on. But it is going to be a tense period in India-Pakistan relations once again.
All right, Parikshit, thank you very much for that. And we'll of course, keep coming back to you for updates on the story throughout the day. Lots of focus on this from a financial market perspective as well. Tata Consumer is the stock we want to shine the spotlight on. Mangalam is here with why. Mangalam, morning.
Good morning. So Tata Consumer reported its numbers yesterday. While the overall results were largely in line, there were a few bright spots that the company reported this time around as well. If you look at the revenues, they were above street expectations by about 25 to 30 crores. The EBITDA, despite a 420 basis points decline or contraction in gross margins, actually were better than what the street were expecting, and the net profit was further aided by a 45 crore exceptional gain that came by as well. If you look at the categories as well, in the India beverages business, the organic revenue growth was close to around 9%. The street was working with a number of 10 to 11%. Foods was where the bright spot was. Organic growth out there was 17% as against expectations of 11 to 12%, partly led by growth businesses, partly led by the price hikes that the company had taken in their salt portfolio, and partly led by a strong performance of their other verticals as well. The international segment grew by about 5%. The street was again working with that number itself, largely led by US, but there was a decline which was expected in the UK, and that's exactly what has happened. The brightest spot for me was the growth that the company reported in their non-branded business, which was 25%, led by 60% growth in their plantation revenue. And secondly was the Nourishco business, which came back to growth after 2 quarters of underperformance. A 10% growth is what their Nourishco portfolio reported this time around, with an 835 crore revenue for the entire year. See the stock mild green after a strong outperformance this month.
All right, Mangalam, thank you very much for that. We're starting 50 points lower on the Nifty, so 24,288 is where we're at. The Nifty Bank is down about 0.3%, 55,184. Sensex is down about 0.17, 79,978. And I think you got some green on the small cap index, 16,980. Mid cap index is absolutely flat, but there's some green on both in the broader space, broader markets. Otherwise, I mean, it's slightly sideways, slightly subdued. It's 12% in 9 days on the Nifty, and running into, of course, some adverse news flow here as well. So 24,280 is where the index is at. The Nifty heat map maybe will quickly come up, and we'll just look at which way things are. So it's all mostly down. I mean, I think about 30, 35 stocks are lower, and about 15 odd names are higher at this point in time.
And Bajaj Finance is in leadership position. I'll tell you why. Because the board is meeting today. They'll be considering not just a dividend, but also a stock split. And typically retail investors like that. Just makes ownership a little easier. Stock at an all-time high this morning of about 9,450, almost 9,500 on Bajaj Finance. So that's the big mover. Tata Motors is the other one that's tracking some green. There's IndusInd Bank on the upside. Nestle ahead of numbers is up about 1%. Let's look at Tata Consumer and see what it's doing. Tata Consumer is actually down about 4%. So the stock's selling off on what seems to be an inline performance in the fourth quarter. Tata Consumer actually is the weakest stock on the Nifty. With that cut coming through. Eternal, which has had a good week so far, it's cooling off as well, 2% lower on Eternal. And there's news on Eternal as well. Let's not forget, there is a management change. Mr. Dipinder Goyal himself is going to take over the food delivery operations now. The current CEO is moving out to another business, still in the company, but to another business. It seems like it's a regular reshuffle. but the stock is lower. Bharti Airtel, Sun Pharma, HDFC Bank, these are the other losers. Banks in general are a little soft again this morning. ICICI Bank also lower by about 0.5%. Kotak is also slightly lower. L&T Cipla also slightly down. So very muted and quiet for the time being. IndusInd, by the way, is seeing some interesting buying, about 1.5% up on IndusInd.
Well, that's right, Surbhi. And a couple of more stocks actually that are calling for our attention. Thyrocare, solid set of numbers. There is valuation comfort out there. So that's the big bazooka move this morning. Thyrocare is up close to around, I think, 8-9% the last time I checked. Let's get the intraday chart up for you on the screen. Syngene, disappointing numbers with disappointing guidance as well. Waaree Energies, that's the one that's given up a little bit post yesterday's big run. So that's coming for some profit taking. Vascon, well, that stock is up close to around 5% or thereabouts because it won a 200 crore order. Syngene now, it's down close to 10%. That's actually a lower circuit on that particular name. So just keep an eye out on that one. Vascon is up close to around 6%. That's won a 200 crore order. So I think we should get that as well up for you on the screen. It's at the 100 DMA. So keep an eye out on Vascon. Spandana Spurti, the stock started off in the red, but it's recovered from the low point of the day. A few factors at play. Mr. Ashish Damani that now takes charge, he's been longer there than Mr. Shalabh, so that's why that could be one factor. The management commentary as well was positive, that they see settling down of this MFI stress in a quarter or so, which is another positive, and valuations at around 0.85 times give some kind of support. So because of this, after starting off gap down, and yesterday the stock was down 5% as well, that's recovered from the low point of the day. And Dalmia Bharat, as we said, the numbers are more or less flattish. The way ahead could be better. That stock is up 3.5%.
Absolutely. So lots of movers, right? I mean, we're still on the Nifty down about 45, 50 points to start the day. And the biggest volume-led loser, I mean, price-wise, it's just a 3% cut is Waaree. But look at the volumes. It's huge volumes coming through on Waaree Energy. At 29.35, yesterday, of course, it was up some 16-17%, but almost quickly clocking up to about 1 million odd shares on the NSE. LTI Mindtree, of course, Rima was highlighting that. Syngene, we've highlighted. Tata Consumer, Mangalam just spoke about that. It's down 3%. Eternal is down 1.25%. Max Health is down 2%. K Fintech, big winner in the last 1 week, 2 weeks. 3% down, about 12.50 on K Fintech. And so on and so forth. Rallis is down about 5.5%. It's got decent-sized volumes as well, but not high, but some volumes in it. And of course, I mean, Samhi is up 5%, so 182. Stocks up 25% coming into this deal. It's up another 5 this morning on Samhi. So, yeah, I mean, there's a fair bit which is going 60 points lower on the Nifty.
On Tata Consumer, I started going through a lot of the brokerage notes, but just to sort of gauge market reaction and pulse. Jefferies is the one that's actually downgraded the stock. And what is their rationale of doing this? They're saying, first of all, this tea inflation is really hurting margins. They're not too happy with that, though growth is okay. And more importantly, they're pointing out the obvious. The stock is trading at 70 times FY26 earnings. So they just think it's too expensive. So therefore, it's a hold now for them. That's a Jefferies view on Tata Consumer.
Absolutely. So 2.5 lower on Tata Consumer. Dheeraj Agarwal is Managing Director at Ambit Investment Managers. Dheeraj, good morning. Good to have you back on the show. Thank you for your time. What's the view now, Dheeraj? Have 12% in 9 days on the Nifty. And, you're again, gains come so quickly, you just snap back that you're left wondering, what now? I mean, and stocks uniformly are up 20-25%. I'm talking about, say, BSE 200 or a well-tracked group of stocks. What's your view from here?
Yeah, so if you actually zoom out a little bit and ignore the fast down and fast up moves, market continues to be in a large struggle zone, right? So it falls very fast, it comes back very fast without actually going anywhere. So the last time I think we discussed on your show, I basically said, look for 1 or 2 years of just single-digit kind of returns. And I think I maintain that view. But it will be through bouts of optimism and pessimism where we will see sharp moves on both sides. So it's not one of those kind of markets where you'll see a vertical down kind of a correction. For that, you need some big shock to happen. I mean, the tariff issues could have provided that shock, but India looks like a bit of an island of safety or oasis of safety within the whole tariff war, which is currently going on. So I broadly maintain it's a large range market. We will keep on doing top of the range and bottom of the range many times before the mean reversion actually happens.
So continue to be a little cautious in the market. Dheeraj, good to have you with us on the show this morning. Now, so what is the issue? And for a second, I'm just leaving aside this entire trade uncertainty and whatever's happening with tariffs. Hopefully, we'll get a better deal. At least that's what the market believes, right? That India will probably get a much better deal than a lot of other countries. That aside, why else are you far more cautious? Is it that you're not convinced about this whole earnings recovery story? Is it something else?
So two things, Surbhi. One is you can't fully ignore this whole tariff issue, right? Because to my mind, one thing is very clear: the current disruption or change in the global financial order, the global trade order, which is happening, has two clear implications. One clear implication is there will be a slowdown in global economy. Now, we will have to wait and see whether the slowdown is shallow or deep, whether it becomes a full-blown recession. But I think it's pretty much a given there'll be a slowdown in the global economy, and India can't remain fully protected or shielded from the fact that the global economy itself will slow down. So that is point one. Point two, domestic economy itself has been slowing down for the last few quarters. I mean, we can see that in the top line of Nifty or BSE 500 earnings. Bottom line has been telling a different story because of the margin uptake which happened for a few quarters. But the top line growth has been anemic in the region of 7 or 8%. Domestic economy has been slowing down. So if you add on top of a slowing domestic economy, a layer that the global economy will also slow down in the next few quarters, I think earnings will see more cuts. So as you rightly mentioned when you were discussing one of the stocks that brokers are downgrading because of valuations despite okayish earnings. So that's the challenge. When where the earnings are okayish, valuations are too high. Other places we are seeing a little bit of earnings downward pressure. So both these two things will keep the market in a bit of a struggle zone, I think, for some more time to come, according to another year or so.
So, Dheeraj, where are you on earnings, if I could just ask? Because the street consensus, when we kind of began, FY26 was supposed to be somewhere around 12 to 14%, depending on whom you're listening to. What is your base case expectation?
So this is just a very, very top-down guesstimate. I don't have estimates. So very, very top-down guesstimate looking at the way cuts are still happening in many spaces despite good results. I would say we would end FY26 in high single-digit range. So 7, 8, 9, that kind of a range.
And that's not in the price, is it, Dheeraj? 7 to 9% earnings growth this year. That's not in current stock prices, is it? Or is it?
I don't think it is. I don't think it is in the because that level of earnings disappointment is bound to slow things down, right? So I mean, there are two things which are playing in the market. So one is the narrative of what is happening in the global scene. Second is the actuals, which is the earnings. And in the near term, India actually benefits from the narrative that India is an oasis of safety in the tariff war. India has a very good relationship with the US, and we are trying, and that's a fantastic job achieved on diplomacy by the current government to do a trade deal with the US fast. And as a supply chain alternative, this is the third time in the last 17 years that we are staring at a wonderful opportunity of making India a supply chain destination. Whether this time we are able to do it or not is a question we will see going forward. But these three narratives are playing on the positive sentiment on the market. But if you look at the earnings itself, weakish, nothing to write home about. And there's no upward revision in any of the earnings which are coming out. Either it's flat or we are seeing downward revisions.
Okay. All right. That's a sobering thought and one we must take on board. And perhaps eventually they say earnings is the fuel of every market. And if we're looking at more cuts ahead, it could be maybe a little problematic. All right. Got it. Thank you very much, Dheeraj. Good perspective this morning. Appreciate you joining us on the show. For the timing, we're moving on and putting the spotlight on a big deal that just got announced. Sami Hotels. And this is exactly in step with what Nimesh was telling us earlier. Now, we have the management of the company with us to talk about their strategic deal with GIC. GIC is all set to acquire 35% stake for a total of about 752 crores in 3 subsidiaries of Sami Hotels. Ashish Jakanwala, Chairman and Managing Director and CEO at Sami Hotels, is with us. Ashish, great to have you. Thank you very much for joining it. Good morning and congratulations on a big deal. GIC is a marquee name. Now let's go through the whys. I know you want to use a lot of this money to pare down debt, but what exactly is the transaction? What are these 3 subsidiaries and how soon does the money come in?
Thank you for having us. Absolutely, we're very excited about this transaction, largely on account of the quality of partner that we are getting. So I don't think I like to belittle the whole transaction by just only focusing on leverage. Clearly, that's a great end result. But what this gives us is a strong partner for future growth, especially in the upscale and higher category of hotels. As you've mentioned, we have picked up 3 of our existing hotels where GIC has picked up 35% stake against a total investment of 752 crores. This does multiple things. It reduces our debt significantly, on closing. That frees up a lot of our free cash for future growth. And in addition, GIC and Sami are committed to growing this whole partnership to about $300 million. So we do expect both partners to put more capital for future growth in this business. In terms of timing, the deal is subject to customary approvals such as shareholders' consent. We believe this should be in place by end of May. And majority of the investment comes upfront, which should get done, I would think, by June end. And the balance comes in Bangalore asset over the next 2 years. But majority is coming
what you said, actually, sorry to come in, but what you said was very interesting. And I was just going to ask you that. Is this the first of more or the first of many? And you said the partners are committed to putting in more capital. So are you open to selling more stake? Could you be looking at deals in other properties as well?
No, so I think the larger part of the deal is that we've incubated the deal with these 3 assets, but both the partners will look at new acquisition opportunities in the space, wherein both of us will bring future capital to deploy. So it's not just about Sami continuing to bring more assets in the platform. That clearly is an option, but I think the bigger focus is to also look at opportunities outside. We've had tremendous success over the last decade in our acquisition strategy. And we believe getting a partner of GIC's stature and obviously kind of fixing a balance sheet, both of them put together gives us tremendous appetite and potential to grow through acquisitions.
Ashish, hi, good morning. Prashant here. Congratulations on the deal. So just to understand, is this something similar to, so GIC was an anchor investor with DLF, for example, right? Early anchor investor. Or, for example, if you take a look at the case of Max Estates, again, another real estate company, but also sort of operates commercial properties, etc. They have New York Life as a kind of anchor investor, and they go asset by asset. Is that kind of the roadmap to think about this?
Prashant, hi, yes, absolutely. Besides the 3 seed assets, both the partners will look at new opportunities on an asset by asset basis. And if both the partners like the opportunity, we are committed to bring in capital in the ratio of 65-35, 65 from Sami and 35 from GIC.
So that is in the agreement. Anything you do in the future, it'll be in this 65-35 ratio.
In the upscale space, Prashant. As you know, our business is spread across upscale, upper mid-scale and mid-scale. The joint venture that we've set up, or the partnership that we've set up, is targeting the upscale segment. So hotels that we look at in the upscale space, we will have to take it to the joint venture or the partnership first before we do it on our own balance sheet.
Okay. All right. Hi, Ashish. Good morning. Good to see you in. Nigel on this side. Could you tell us what's the contribution of these 3 subsidiaries in terms of revenue as well as profitability to the entire, the listed entity?
So, Nigel, about 30%. These entities put together contribute circa 30%. I'm talking December 2024 numbers. If I take trailing 12 months as of December, about 30% is the contribution to revenue and EBITDA of these 3 hotels to our overall portfolio.
Got it. Okay, all right. Now, the net debt has steadily been coming down. If I look at it, when you joined us a couple of years ago, it was 2,800 crores, then it came down to around 2,000 crores, and you had told us in the time to come, it will reduce. Now, post this fundraising that you have done, what should the debt number be, say, by the end of FY26, FY27? What's the rough number we can work with?
So immediately on closing, the net debt will come down to about 1,460 crores. Interestingly, that absolute number, Nigel, helps us achieve a target of near-term going below 3.5, within a year going below 3 times, and fairly quickly getting to our stable target of 2.5 times net debt to EBITDA. Therefore, we can look at deploying a lot of our free cash towards growth, but we believe our net debt will remain in the zip code of 1,000 crores to 1,400 crores over the next 2 years. It all depends on what's the deployment of our free cash. And it's an important perspective because we will see almost a 55 crore reduction in our interest expense on an annual basis. So our free cash growth will be pretty substantial. And if we can find acquisition opportunities, good. Otherwise, a lot of that will eventually end up reducing our leverage beyond 1,470 crores.
Okay, all right. Ashish, you've given us very good numbers. So, thanks for that. But if you could tell us, it's too early to talk about, they're just entering, but what's the exit plan for GIC? Is there already a structured deal or something that you'll have already worked on? Or you said that they could be interested in other assets as well. Will they deploy some more capital?
Yeah. So I think the intent is for the partnership to grow substantially and both partners to put more capital. And Nigel, with that, I think it's too early to talk exit. We both are very excited about both India as a market, hotel as a sector, the acquisition and turnaround strategy that Sammy has deployed over the last decade. So I believe there's a lot of growth that we can leverage in the cycle and in the sector. There are obviously provisions for monetization of investors' stake. But Nigel, we have a credibility and experience of working with institutional capital for the last 14 years. So if any point in time in future, there is a requirement of monetization, we feel that should be an easy path.
Ashish, that 65-35 ratio that you mentioned, right, for future projects, upscale hotels, as you said, could you give us a sense of what the number of keys at Sami right now is? And you already have a pipeline, right, of identified upscale properties. What is that number? And in how many of those cases will this 65-35, will GIC come in? As things stand right now, yeah.
As of today, as I said, they are in these 3 subsidiaries. These 3 subsidiaries will eventually own 5 hotels. The Courtyard Fairfield in Bangalore Outer Ring Road, which is an operating asset. The Hyatt Regency in Pune, which is an operating asset. And, we had acquired the Trinity Hotel in Bangalore Whitefield in October, which eventually will be rebranded as Tribute under the Marriott portfolio and a new Westin block. So, they are currently picking up 35% position in these 5 hotels across 3 subsidiaries. As I mentioned earlier, we are keen to evaluate more opportunities to add to this portfolio, but I really don't have a definitive agreement on any future pipeline that I can discuss today. But the plan is to definitely grow this partnership using both the opportunity, the capital, and the skill sets we both bring.
So, Ashish, just on that point, because you've given us an idea of the debt levels, you're saying that after the paring down, debt will not exceed 1,000 to 1,400 crores. At the same time, obviously talking about, investing more in the business. So, at least from Sammy's point of view, what is the additional capital requirement that you see to deploy into these 3 entities and even overall otherwise? I mean, give us some sense of the leverage levels that you'll keep at a debt equity ratio, and how much more capital will you bring in? What's the plan on the equity capital side?
On the debt levels, we've had a fairly committed position to the investors. We had said 3.5 times near term, and 2.5 times is what we believe will be a good, healthy, steady state, given the fact all of our debt is pretty long-term, 12 to 14 years, right? So we will get below 3.5 times on closing. We will get below 3 times in the next 12 months. And that obviously accelerates the path to get to that stable 2.5 times net debt to EBITDA. So that stated strategy and promise to the markets remains steadfast. The only thing which is changing is we are accelerating the timelines to get there. Now, with that, what happens is a lot of our free cash over the next 3 to 4 years gets freed up for growth. And if we take some rough estimates, we believe we'll get some 1,000 odd crores of free cash over the next 3 years from our business. And that's now available for growth because Our net debt is already at a level where we'll reach 2.5 times, if not lower than that, over the next 2 years. So we have a reasonable firepower. And to add to that, whenever we do an asset in upscale, GIC has an ability, subject to obviously them liking the deal, contributing incremental 35%. So I think what we are doing is we are really augmenting the firepower to grow the portfolio. And our focus is really growth because, as I said, and I'm sorry if I repeat it a few times, leverage is clearly sorted in this one single transaction.
With the partnership, GIC has got investments globally as well in other hotel companies, I think with Westin and a couple of others as well. You work with Marriott, of course, is the big one for you, but you have, I think, 3 international hotel flags so in terms of, the multi-brand exposure that you have. Will we see more, and does that change in any way towards one or maybe addition of more?
We've always maintained a brand agnostic approach to investing. So in future, we will look at each hotel and each opportunity on its own merits. We are tracking many other hotel companies and brands that we like. And I'm quite sure that the bouquet of brands and the partners that we work with would expand in future.
Just very quickly, Ashish, before we let you go, this GIC deal that you've done, is it exclusive or you can tie up with others as well?
So on the upscale hotels, Nigel, it's exclusive. If we do any hotel in the upscale space, we need to take it to the joint venture first. But in the mid-scale, lower mid-scale space, there is no such exclusivity. But having said that, I'm personally not a big believer of exclusivity, but I'm a big believer of partnership. So as we've done partnership with GIC, we'd like to explore opportunities to grow this partnership, whether it is in contract or outside of the contract, because each partnership takes a lot of time to build trust and ability to do some things together. And obviously, once we've done that hard work, I would like to believe both Sammy and GIC would like to leverage that hard work that we've done, the trust that we've built to do more and more.
Sure. So more partnerships like GIC?
Sorry?
Should we be expecting more partnerships like the one with GIC? Maybe in some of the mid-range hotels as well?
Not in an immediate way. Not in the immediate.
Not in the immediate future. Got it, Ashish. Thank you very much. Very helpful conversation. Thank you for making us understand the structure of this deal, and good luck with those plans. We need to head into a very quick break now. Up next on the other side, the big auto discussion. The primary market will soon be buzzing with an EV IPO. It's a big one. What lies ahead? You're seeing some flashes right now on the Delhi EV policy on the screen as well. A full-blown discussion coming up with Hormaz Sorabji of Autocar India and Kumar Rakesh of BNP Paribas. Welcome back. So the market for the time being hasn't done too much, just about 50 points lower. The next sector on which we're putting the spotlight now is the automotive space. We all know that Ather is the next IPO in town. It'll be the first big IPO actually of the current financial year. It's all set to open for the general public next week. And for the anchor investors, it opens out on Friday. So what does this really spell for the EV sector in India, particularly, of course, EV two-wheelers? That's what we're looking to discuss with our next set of experts. Joining in are Hormaz Sorabji, editor at Autocar India, and Kumar Rakesh, India analyst, auto and IT at BNP Paribas. Gentlemen, thank you so much. Great to have you on. Thank you for joining in. Hormaz, I'm going to open with you because I go back to a conversation that we had on Ola. And this is well before the Ola stock price decline had started. And we were flagging off some concerns in terms of, after sales, the product itself and all. Short point is that Ola has been a pretty bitter experience from an investor standpoint. And on a separate note, there's all this going on with Blue Smart. So in general, in this environment, we have now Ather coming in, very different company. But what can investors expect? Will it be a little sweeter this time around?
I think for sure, I don't think you can paint both companies with the same brush. I mean, I've been very open about it. Ola absolutely very, very poor credibility. I think just the way they've gone about it, I think they've taken investors for a ride, is my view, just the way they've gone it. And, you've seen the reports, compliance issues, regulatory problems, very, very typical. My basic issue with Ola is that, from a technology standpoint, I've really not seen any breakthrough in what they've been doing. It's still the S1 Pro, which again is, a product which has come from Europe and adapted over here. I don't see any huge R&D capability in the company. I mean, the cells they are planning to make also as a 4680 cell. Is that suitable for a small scooter? I have my doubts on that. Whereas Ather, to me is actually far more refreshing, much more credible. They're sorted on their engineering. And, I actually have a lot of faith in that company. And so I said, you can't paint both with the same brush. So I think that's what investors also need to know, that, you have to, and obviously what's happened to Blue Smart, again, there are promoters and there are promoters. So they're not all cut from the same cloth.
Absolutely. Hormuz, but just one follow-up question. The only issue, again, purely from a market and investor standpoint, is that there is so much and such rapid, frequent policy change within EV, and that's always going to be a risk, right? Look at the lobbying that's happening in Delhi, and that was, I think, a source-based story that our colleagues in Delhi had just put out. The hybrid guys are now lobbying. They want hybrids to be given the same kind of treatment and perhaps incentives as EVs. So from a two-wheeler standpoint, since we're talking Ather right now, is there any policy uncertainty, regulatory issues, any such risks that investors should be very well aware of in the immediate future?
Well, I think, the policy uncertainty, the fact that, policies are not defined well in advance. Again, this whole thing on CAFE, it's just been stretching. So I think that really is a big fundamental issue that, affects the entire industry, not just EVs, especially the ICE guys, because, emissions is a bigger issue for them and a bigger challenge for them, where it's not so much for the EVs. But you're right, I think these constant flip-flops between, especially at the state level, as you said, you've got road tax, once it's waived off, then it's come back on. So that does cause a lot of uncertainty. But I think, what's very clear is that EVs are the future. They will always have a huge fiscal benefit over ICE vehicles. And I think, especially with scooters, I think that's really been the segment that's led EV growth, because scooters lend themselves best to electrification. So I think that is the safest bet right now in the EV space. Of course, it's getting very competitive. You've got the legacy players also fighting back. Bajaj Auto, I mean, it's really kind of up the ante. TVS there as well. It's all come at the cost of Ola, which we've seen their market share has completely fallen. So it's not going to be easy for Ather either. You've got really strong legacy players in this game as well. But I think at least what I see is that, they've approached it right. Their fundamentals are right. Their products are good. And, they're not in this mad rush for massive volumes and growth and, a lot of smoke and mirrors, the way Ola has kind of, projected itself.
I mean, strong words, and always strong words.
That's why we like Hormuz. He cuts through the web.
Absolutely. By the way, Ather, guys, is like the poster child for, incubation out of educational institutions. It's come out of the IIT Madras Research Park. So if you go down there, it's like a point of pride, Ather and what the founders, etc., have done with that company. Kumar, come into the conversation. I mean, as an analyst, what is your assessment of Ather? We've got the price band now. The RHP, of course, has been out there. We've been reporting on many of the details and they'll come up on the screen. But what is your sense? Ather.
Hi, good morning, Prashant. I'll not be able to speak specifically about the company, but I think what Hormuz was earlier saying, that in the two-wheeler space, especially in scooters, electrification seems to be a structural trend. It is the cost advantage customers have very well started appreciating. And that is something which we have seen over the last 2 years when the incentives have been coming down on the electric two-wheelers. The penetration falls for a month or two and then revives back up again. So, and then continues to grow. So that structural shift towards electrification in the two-wheeler space, we think is already pretty much underway, at least for the scooter segment. We'll have to see how much of success EVs can make in motorcycles. it would be relatively more complicated to electrify motorcycles at attractive price points. But at least we have enough and more headroom right now to electrify the entire scooter space. And that is where many of these new age startups are working. And some have started creating pretty good niche using their differentiated vertical integration and technology know-how. While the incumbents have definitely established the leadership, a couple of more Japanese players also will enter the electrification journey through this year, and we'll have to see how that redistributes the market share. But for the startups, the space would be really to create a niche for themselves, and technology is a good differentiator to create that niche.
All right. Hi, Kumar, Rakesh, and Hormuz. Thanks a lot for joining in. Well, Kumar, I wanted to ask you, there has been this talk that India is going to go a little bit easy on the duties, and then we'll have, the Harley-Davidsons and other US automobiles here in India. Do you think it is reducing duties, but actually we're not really giving away anything? Markets are very different. The left-hand, right-hand drive is very different, and maybe they don't make much of a dent. What's your take?
I think, yeah, I agree. Now, the incumbents in India who are selling are well established. The brand perception about the brands which are available in the markets are very well established. And now I wouldn't expect that to create a material impact on the existing structure of the market, partly also because of the price point at which these products will come potentially would be much above where the average price point in the market is. On the car side, the average price point is close to about 11-12 lakh rupees in India, which is significantly below the average price point what it is in Europe or US for that matter. And hence that may not create a lot of impact, and even more so in the two-wheeler space. The market in India is very different compared to US. And we have seen this in China as well. China earlier used to have a lot of restrictions in terms of global OEMs entering into the Chinese market. They necessarily need to have JVs and such restrictions. But when the electrification journey started, they reduced many of these restrictions. But what we have seen actually is Chinese OEMs are doing far, far better in the EV space now that they have established themselves. The customer and the market is well established. They are able to compete actually quite fiercely with these global OEMs in the Chinese market. And hence now we think we are way beyond the point where these domestic companies or the established companies could see a material impact from any new entrants.
Kumar, what are your top stock bets, auto OEMs?
So we prefer passenger vehicle names over two-wheeler industry. As we are discussing on this show, there's a lot of flux which will happen within the two-wheeler industry, the market share shift in the two-wheeler EV space. Some more entrants would be entering in the EV space, and that will continue to create impact on the ICE volume as well as margin of the overall business. And hence we see the passenger vehicle industry relatively more stable, where the bulk of the competition is within the existing incumbents and we don't have any disruption happening from outside. And also we would expect the long-term growth drivers to be very well in place for passenger vehicle industry. And that's why we prefer Maruti, Suzuki and Mahindra. Mahindra is delivering a pretty solid volume growth, and even their farm equipment business has been doing pretty solid.
Yeah.
So we would expect them to continue to deliver double-digit volume growth. Maruti, from a longer-term perspective, the points which you were earlier highlighting there, hybrid at some stage may start getting favorable policy support. Even without that, globally, we have seen hybrids to do much better than EVs in most of the markets, barring, say, China or UK. In UK, more for regulatory reasons, EVs have done better. But hybrid is the powertrain which has really picked up in the recent years, and India is behind in that curve. So we would expect at some stage hybrid in India also to start picking up, and the key beneficiary of that would be Maruti.
Got it. So Maruti, you like. M&M obviously has been the poster boy of the Indian automotive space from a financial market standpoint, which brings me to my final question to Hormuz as well. Hormuz, going back to passenger vehicles for a bit, you just heard the comments that Kumar made. The stocks, the companies, barring M&M, they've all been struggling just because of lack of growth, right? And against this backdrop, we have every day Mr. Elon Musk tweeting, saying that duties need to be lowered. We don't know what finally that trade negotiation is going to be like. And I don't know if he can bring duties down to zero on an imported car. That would be almost unheard of in India before. But what should we be prepared for next 6 to 8 months on the PV side within this whole, Tesla knocking at India doors perspective?
Yeah. Well, I think firstly, you could have some serious reductions in duty, but they would be coming with conditions. It could be for a limited number of units. It could be above a certain price point. So I don't think, as Kumar says, it's going to really impact the kind of the core of the market. And over here, our cost structure is so strong, it's very difficult, for even, imports to compete with a lower duty if you try to go low down over there. But I think, the EV space, again, I think 2025 is going to be a very, very crucial year. Clearly, we've seen, let's say Mahindra, which has launched two vehicles. A bit of a measured start. I think they haven't really gone full tilt on it. I think they're making sure things like the software and all are sorted before it reaches the hands of the customer. And I think you've got Maruti now coming in. We'll have to see what they do. It'll be very interesting. I think what Maruti will do will leverage its network, which is quite essential from an charging infra point of view. And that could be Maruti's play, not so much the product, but the EV ecosystem, which will, kind of be their play. Hyundai have launched the Creta EV. Again, a tepid response, really not as much as we thought, doing under 1,000 units a month. So, I think it's going to be very interesting in terms of how the EV segment plays out. But what's for sure, I think from a 2.5 penetration, it's going to be substantially higher. Best case situation would be perhaps, let's say 3.5 to 4%. But it's still, again, very, there's still a lot of barriers in the EV space. And I think infrastructure is primarily the largest one.
Okay. All right. Gentlemen, thank you very much. Very insightful discussion, very helpful one. And let's see what the next couple of weeks bring for the Indian automotive space, starting with, of course, this Ather IPO. Thank you for joining in this morning. Well, with that, let's head back to the market. Markets are absolutely fine. The Bank Nifty, actually, if anything, has recovered now from their opening cut of 0.5%. It's flattened out. We've got Mitesh joining in with some more details.
Well, that's right. Just want to highlight a couple of stocks. Whirlpool is now at the high point of the day. It's up 3.5%. Overnight, you had Whirlpool Corporation that came out with its set of numbers. They've given the Asia breakup. And the read-through from most analysts, and I have a sell-side note, they are stating that India is likely to have done well. Remember, the challenge is what the promoter is going to do with the India business, which is going to be important. But at least operationally, whenever Whirlpool India does report, it could be a pretty okay set of numbers. Could explain one of the reasons why the stock is up close to around 3.5%. But let's get back to Mitesh. Mitesh, what's your take of the initial 45 minutes of trade, and also give us a couple of picks?
Morning again. I think it's a market, which is just trying to consolidate. I think extremely overbought readings on the hourly to hourly chart suggest that there will be profit at higher levels. And I've been maintaining that on the index, if somebody wants to enter now, use declines to enter. So I think, wait it out. I think 24,100 and then 24,050 are good support pillars. I think that's where one can explore buying. Till then, keep your powder a bit dry on the index. But on stock side, a lot of stocks are still showing a tendency of moving up and are showing some kind of a breakout pattern. So I have a buy on Adani Energy Solutions. Keep a stop at about 935, which is today's low. Look for a target of around 980, about 990 on the upside. And the other one is Sun Pharma. Pharma as a pack is doing well, and Sun Pharma yesterday had a breakout, today is sideways, but the setup is positive. So I'll want to take a trading bet here. Keep a stop below levels of 1770 and look for a target of around 1845 to about 1850.
Okay, well, interesting ideas and trades. Mitesh, thank you very much for that. Well, let's bring in an exclusive conversation now. Tata Power is assessing opportunities for setting up large or modular nuclear plants, says Praveer Sinha, MD and CEO of the company, in an exclusive chat with my colleague Shireen Bhan. He also spoke about opportunities in the solar module space, capacity expansion there, and more. Listen in.
We've just seen the US impose tariffs to the tune of 3,500% on Southeast Asian countries when we talk about solar equipment. Now, does that open up an opportunity for a company like yours?
Well, it does open up opportunities for us, especially in terms of supplying these modules to not only US, but also to many countries globally. And that's an area that we are very seriously looking at, that how do we not only meet the requirements of solar modules in our country, but also export it and
cater to the requirement of some of the other countries.
How much capacity would you have available at this point in time, which could be used for exports if that were to be the case?
Well, we today have a manufacturing facility of nearly 4.9 gigawatt. Most of it is actually tied up, but possibly up to 1 gigawatt we may be in a position to sell outside the country.
Would this also then perhaps accelerate capacity expansion plans?
Absolutely. We are examining that now that we have commissioned our 4.3 gigawatt plant, the solar cell and module plant in Tamil Nadu. We strongly believe that we have a capability to execute projects very fast and ramp them to full production. So we are definitely examining such opportunities. And based on how the market conditions are there and how some of the things that will evolve globally, we'll take a call on adding capacity.
And do you believe that this call is likely to be taken sooner? Are we talking a few weeks, a few months?
Maybe in few months.
In a few months. Well, again, speaking about the opportunities that you are considering at this point in time, and you brought up the issue of nuclear power, and that's a move that India has now decided to further. In fact, the budget, the finance minister made the announcement of amending the liability clause, and there seems now to be a concerted attempt by the government to move down that path. What does it mean for Tata Power, and what does it also mean for India?
I think in the energy transition, one of the gaps that we had was we need to have a very efficient base load generation, and nuclear fulfills that requirement. Government has very timely taken a decision that they will open up for private sector, and the government plan is that we will have at least 100 units of SMRs by 2047, which I think is a right move and a correct move given the huge growth of power that is there in the country. The important thing is that this will also bring the best technology which is available globally, as also Indian technology. We have the Bharat small modular reactor, and that is something that we can start with and then get some of the newer technologies from other parts of the world. And for Tata Power, this is an opportunity that we are looking at. We are identifying places, locations in the country where it is safe to put such large or modular nuclear reactors. And I think we'll play a very important role in the whole opening up of the nuclear reactors in the country. And I think you will find that going forward, we'll set up a few plants.
Well, you've made it very clear that you do intend to get into this space and set up a few plants. Of course, the legislative action will take its own course, but how ready and prepared are you at this point in time to move forward on these plans? You said that the process of identification has begun. So realistically, what are we talking about in terms of timelines? As and when the legislation, of course, gets through.
So typically, it takes about 2 years to get the land and get the necessary approvals, permits from various government bodies, statutory authorities. So we are looking that maybe 2 years hence, we would be in a position to start work on construction. Typically, these type of projects take 4 to 5 years for construction. And we do expect that we will be in a position to be ready with the plant sometime in early part of 2030s.
Sometime in the early part of 2030s. But, again, for the benefit of all of our viewers who are watching, what does it take to set up an SMR? You were talking about technology, you were talking about indigenous technology as well. What are going to be some of the challenges that one will have to contend with, to be able to make this a reality?
So the most important part of it is how do we make them safe and secure for operation. The nuclear island, which is the main heart of the plant, is something that has to be constructed. We do have a large number of companies in India who make these type of equipments, and we need to put that together and give them the confidence that large number of nuclear plants will come up. So to that extent, we need to get them organized to cater to the requirement of the private sector. The second is the power island, which is like the normal turbine, and those are very well known, and the balance of the plant. So So I don't think they would be really a great challenge if we have a good technology partner. In India, we have the Nuclear Power Corporation, which has the right technology and also the competence to support in setting up these type of plants. But globally also there are large number of companies.
Westinghouse?
Yeah, absolutely. And then there are the French companies and
are you in talks with anyone at this point in time?
Well, yeah, we keep on discussing with them because technology is something which is evolving very fast, and it's very important to keep ourselves abreast with what's happening globally. So we are very excited about the opportunity. This is a new way in which we can produce clean power, and I think we will have large number of them, not only setting up these type of plants in remote locations, but also in locations where we have the load and we will be in a position to set up and operate in a very, very safe manner.
What would the capex be for an SMR typically?
Well, the capex is very large. A normal coal-based plant costs about 8 to 9 crores. This will be double of that. But the cost of uranium or the fuel that you use in nuclear plants is much lower. Of course, the whole tie-up of getting the fuel, the processing of that fuel, the spent fuel that has to be taken away, all that has to be done by a government agency. We need more clarity on that in terms of how the government will set up a separate entity which will support the power companies, which will set up these SMRs. So I think there's a whole lot of work that needs to be done, but I personally feel that the cost of power from nuclear will be as competitive as the cost of any other firm power that comes, whether it is from brown coal or it is from any other way that we produce 24/7 power.
All right, that is Tata Power. Let's quickly move on and focus on some of the other stocks that are on the move. We have Vinny standing by, who's tracking Syngene and Davies. Vinny.
Hi, morning. So yes, keeping an eye on both these stocks today. Davies, firstly, it's on the back of a brokerage note. Citi has given a buy rating. Target price is what they've increased. 7,050 rupees from previous target price of 6,850 rupees. Now, why? Because they believe Davies has a high potential to become the primary supplier to Eli Lilly's oral drug, which we had recently heard that, phase 3 trials, the trials that were going on were quite efficient. So on the back of that, they believe that Davies has a high chance versus competition to actually become the primary supplier. Why do they believe so? Because the Davies has a lot of capacity that is there as well. They're focusing a lot in terms of capacity addition as well. Current capacity, 300 metric tons is there. Planned capacity is also there for the company. And because of this, Citi believes that Davies has an opportunity actually and forecasted around $800 million plus GLP-1 opportunities coming in terms of revenues for Davies by 2030 is the estimate, and Davies continues to be the top pick. Now, on the other hand, Syngene, why we are keeping an eye out on this one? Because they've reported their numbers. A weak set of numbers came in from the company in Q4 FY25. Overall, other than that, what is also there is that FY26 guidance. That's not exciting, and that's not something that is exciting the street as well, because FY25, they believe the revenue will be much lower in terms of single-digit revenue growth is what they're saying, and other inflows in terms of EBITDA and margin also, they expect that to also come
Okay,
back.
all right. Vinny, thank you very much for that. We'll come back to you for a sort of more detailed link, but lever numbers, HUL numbers are out. Usually lever reports later in the day, but the numbers are out in the morning, the first half. When the first hour of market open, they're looking like they are in line, largely in line to slightly lower. Actually, I think on the EBITDA and PAT level, they seem to be slightly lower. Margins 22.8 compared to 23.1. We don't have the volume growth, which we should be able to get soon. And Mangalam is miking up as we speak, and we should be able to go across to him. The top line numbers should also come up. I think that table with the top line and the bottom line numbers, etc., will give you a quick snapshot view or the actuals are compared to the poll. So, is there a big surprise? Maybe at the margin, if you want to be, maybe you want to nitpick, maybe at the margin, at the bottom line level, slightly on the downside. But stocks holding up about 1% for now. Numbers just about coming in. Mangalam, what do you make of the numbers?
These are absolutely in line with what the street was expecting. No quibbling about the margins or the EBITDA as well. The company has reported a revenue of 15,200 crores. What was the street working with? 15,161 crores. When you're working with a base of over 15,000 crore, a 40 crore miss is nothing really to write home about. The EBITDA 3466 crores, growing slightly lower than street expectations of 2% by growing 1%, but that also was expected because of the firm inflation that we've seen in tea prices as well as palm oil prices. I'm just trying to figure out what the underlying volume growth is this time around, but my sense is it's not going to be much beyond what the street was expecting, which was either flat to 1%. Why do I say that? Because the revenue growth has been around 2%, which is largely in line with the price growth that the company has made as well. Net profit growing at 3.6%, again in line with street expectations of close to around 3% growth itself. What is it that the company's done in their segments? Home care segment has been around 5,800 crores. The street was working with a number of around 0 to 3% in terms of growth coming in out there. Foods is where there has been a revenue decline as against a revenue growth expectation. So that's something that we'll most definitely keep an eye out on. Perhaps it's on account of, the decline in tea volumes despite the rises in tea prices. And that's largely because, at higher inflation levels for tea, people move to unbranded tea. So there is a lot of, down trading that takes place out there. Still awaiting volume growth. Nothing yet. But these numbers, largely in line with muted expectations. And on Prashant's comment of them having reported their numbers in the first half itself, I did speak to the management about this. They said from here on, Hindustan Unilever will report their numbers at this hour itself. This is to be in line with the Unilever parent reporting their numbers. Typically, the Unilever, international report numbers come in at around 7:30 to 8 a.m. UK time. So comparing with that, the Unilever India numbers will also come at that time itself. This is perhaps to prevent the arbitrage that takes place between Unilever reporting numbers, their India commentary, and thereafter the Indian numbers coming in at around 3:30 for itself. So from here on, we have to brace ourselves for Unilever reporting their numbers.
Mangalam?
The interaction is at 11:15, so I'll be rushing to Andheri right from here. Meanwhile, we do have Prakash Diwan joining in as well. Prakash, 2% revenue growth, 1% in terms of EBITDA growth, volumes largely flattish. Do you think this is the bottom of the barrel right now, and from here on things can only improve, or maybe just stay put because growth is not coming by any time in the hurry?
No, looks like we are probably at the bottom, Mangalam. The reason being the numbers could have been much more softer than what they are. If you look at this particular quarter, in spite of whatever, higher food, we have a receding food inflation environment, and that is something which you could look forward to in the subsequent quarters. With the quarter gone by, I don't think there was any way margins could have been better or revenue could have been. There's not much of pricing power left after all the grammage changes that most of these larger players have done. My sense is this is close to the bottom, if not the bottom. But the street will like if the commentary is sounding positive on some of these segments that could start picking up. I don't see any reason why it would not form a good bottom and give you an opportunity to participate in the upside.
All right, we're still awaiting management commentary from Unilever. Typically, it comes shortly after the earnings release itself. So we'll await, any sort of comments on the demand environment and, more importantly, what the underlying volume growth has been this time around. But the stock's not giving up because, of course, it's been an underperformer, still trading very close to its 5-year average valuations itself. Amnish, the same question to you. The stock is trading at closer to 5-year, average valuations. It's not done much in terms of a performance when it comes to growth and the stock price move. But from here on, do you think things should improve, or maybe you'll, let that be right now for Unilever in terms of a call?
Okay, the expectations are not very high. And with the inflation having peaked out and the volume recovery overall in the sector likely to be better in the coming quarters. And I think the HUL from the current perspective can give you a reasonably good trade. Say from 2,200 rupees, where it was earlier trading at. Now it is close to 24, but if you look at the last 12 months, it is still significantly below its peak, which was around 3,000 rupees. So I believe that from the current level, there is a probability for the stock to give you a reasonable 10 to 15% return if the volume growth picks up as expected in the industry. But in terms of margins and all, one should keep the expectations moderate because the focus I think is going to be on the volume growth going forward.
No, I remember speaking to one of the analysts earlier on the program. They were saying that you can't fault these companies at least for the dividend yield, right? Yeah. The final dividend is $24. Put all the other interim dividends put together. In the year, HUL has given you 54 rupees in your hand on the stock price. At least that you can't fault them for.
It's about 2% on the stock price itself right now. Be that as it may, 2% revenue growth. It's actually not about the margins. It's definitely not about, the earnings, etc. It's just about growth, which has been fairly anemic. And it's not that 0 to 1% volume growth has been, on a very high base or something. If you look at the trend over the last four or five quarters, it's never exceeded 3% at best. So even if you look at a CAGR over the last 2 or 3 years itself, the volume growth has been just about 2 to 3% at best. So on the back of that, there really is weakness in the external environment, as the managements have been pointing out. But lately, the question is, what is it that HUL is doing internally to pump prime the growth in the near term as well as the long term? To that, they have laid out a strategy, the Capital Markets Day as well, saying that they're looking at 6 verticals of growth, beauty and personal care being one, face, high-end sunscreen, etc. being the other, and then you have nutrition and well-being as well. From a management change standpoint as well, very recently they hired Rajneet Kohli from Britannia to head their foods business. One of the rarest lateral hirings done by HUL. Typically, you have HUL managers going and leading other companies, but here you have Rajneet coming in from Britannia and leading their food business. So what their expectations are. The thing is that with all these changes that the company has been making, Rohit Java has been there for about a year or so. Is this the time where the stock is at an inflection point? Very recently, we had a note that came in from UBS as well, which did say that HUL and GCPL look like stocks at inflection points. That's the question, because, when the results are so muted and the stock is still up around 1.5%, that tells you something.
If you talk to, I've not spoken to many, but I've spoken to 1 or 2 HUL sort of insiders, past and present, and they all make the point that, all these newer brands, D2C, etc., they've been chipping away in some of these fast-growing categories. Skincare, I think, sunscreen as a brand.
Which is why HUL took the fight right to the heart of the matter, right? I mean, I don't remember HUL being in so much press for legal issues as with the sunscreen ad.
Just one. So this person, the one comment stayed with me. He said, "Well, the R&D of HUL is a very large organization. Large organizations typically take a little bit more time to respond, react, etc. But the R&D within HUL, the product lineups, etc., is so vast, and when that gets going." I mean, they can really sort of charge ahead in some of these categories. To that point of inflection, we'll see.
Totally. I can just tell you one thing about this. In all the other categories, you have the disruptors going ahead and acquiring the incumbents, be it financials, be it, technology and all of that and stuff. It is only in the consumer space where it is the incumbents which go ahead and acquire D2C companies. Why is that? Because that's where the power lies. D2C companies, 0 to 100 crore, very easy to scale. 100 to 500 crores, a little difficult. 500 to 1,000 crores, a little tough after that. Beyond 1,000 crores, you have to be with these big boys. So over the last 6 decades that HUL has been here, every decade there has been a disruptor or two which has nibbled away at their market share. But at the end of the decade, the disruptor wasn't there. So if it's the long-term game, then it is HUL. Near-term, of course, it's 1-2% growth that it does anemically. But it's built up a 15,000 crore revenue base per quarter sort of target.
It's an absolute giant. Mangalam, thank you very much for that. 1.5% higher on lever. The numbers, of course, coming through, and of course, the numbers will now, quarterly numbers every quarter in the mornings instead of later post-market close as it was till the last one. Well, we'll take a quick commercial break here. A special segment, it's the economy, Lata in conversation with Stephen Major, the fixed income expert at HSBC, on expected trends in what else but global macros, dollar, Indian yields in focus. Stay tuned.